Good morning, everyone. Am I audible?
Yes, ma'am.
Okay, thank you. Right. Welcome to our fourth session. And today we have our lesson budgeting. We are going to focus on this important area coming under management accounting. And we have today also we have a guest lecturer coming at the end of the session, maybe around 11 a.m. And then he will be explaining or he will be sharing his personal experience with regards to budgeting, how the practical application of budgeting techniques, how to prepare budgets and all. So before that, we'll try to finish theoretical aspects. And when it comes to last week session, actually, I was able to finish the traditional absorption costing method, right? We were talking about cost assignment. So I told you there are two methods, traditional absorption costing method and the activity based method. So I completed traditional one and Professor Abhay Singh clearly explained activity based costing part. So I hope that uh, understanding is there, right? So I'm not going to explain now. In my slides also, I have included some slides for activity-based costing, but I'm not going to touch on these areas because it was already covered during Professor Abhay Singh's guest lecture session, right? He took actually more than 30 minutes to explain the principles and then the practical application. So in that case, I'm not going to go back to the previous lesson, but I think I couldn't share the activity sheet. I told you I will be sharing the Excel sheet. So the calculation sheet I'll be sharing with you now. So you can refer to now. Here in the classroom, I discussed only a very small traditional absorption costing question, but in the slides, there's a lengthy question, I would say. So the answer is there for this. You can try, you can do the calculations and say whether you have understood the principles. So in that case, you can have a better understanding. But meantime, if you have any questions, you can ask me. Right. Okay, so I'll make sure to share this Excel sheet in the WhatsApp group as well. And for today's session for budgeting, I have already shared my lesson materials, my PDF, the slides, and then one activity because we are going to learn the process through one activity. So I'm going to do that activity while explaining the budgets. And then I have shared one very important recommended text, uh, Drury's book. Now, when it comes to management and cost accounting, we always recommend Drury's book. And so I have taken that specific chapter and I have even highlighted the important aspects and I have shared that. So that one also you have received, and activity sheet template also I shared in the WhatsApp group yesterday. I hope WhatsApp group issue is now solved. I informed the CMA. If any one of you are not is not in the WhatsApp group, just let me know, then I can inform them again. But I'll be sharing the template here again. Right now you have the template with you. Right. Okay, now let's get back to the slide, budgeting. Now, budgeting is a very important, a very significant aspect of cost and management accounting. Now, when it comes to budgeting, it's not only about financing people, finance division. It involves all other people in the organization as well. Actually, the finance section, the finance division, has a big responsibility in terms of budget preparation. Full ebook. Mm-mm. That is a problem. Due to some issues, I can't share the full ebook, but chapter wise, I'll be sharing. I hope you received for cost assignment section as well. So, likewise, for lessons, I'll be able to share. Otherwise, I can't share the full book. Right. Thanks. Good. So as I was explaining, organization as a whole has a responsibility for budgets. Now, before talking about budgets, can you share your experience when it comes to budgeting? Now, are you guys directly involved in budgeting process? What is your experience? Or how is your involvement? If you are directly responsible for preparation of budgets or you are just partly involving, what is your experience when it comes to budgeting? Yes. Forecasting the future is the challenging part, obviously. Now, budget is all about future. And based on past and present conditions, maybe we are forecasting the future. That is the hardest part. Because in this VUCA world, volatile world, now forecasting the future is the most challenging task, I would say. Yes, partly. You can always share your experience. I know you guys are not talking. So at least chat in the chat box. Yes, right. Okay, now we'll see the fundamentals first. And actually, there are so many things to be covered under budgeting aspect, but due to time constraints and this course being a short course, I won't be able to discuss everything. So I'm just giving you the fundamentals, but read the textbook as well. And there are so many other things happening outside, so you can always search and learn. So these are the session objectives. And then what is a budget? If I just explain one definition, budgets are a clear indication of what is expected to be achieved during the budget period, most probably the coming year. So basically, budget is all about future. And even though it is about future, budget is based on past and present conditions, maybe, because we are making forecast based on the present conditions. And then maybe for inflation, maybe for changes in interest rates, maybe for changes in exchange rates, we are changing. We are maybe with the plans, mostly with the plans of the organization, with the strategies of the organization, we have to change the budgets. We have to prepare the budgets accordingly. So basically, it is one indication of what is expected to be achieved, futuristic. And it's a quantitative expression. Budget is all about numbers. If we don't have numbers, it's not a budget. So it's a quantitative expression of a proposed plan of action, always coming to future and for a period, specific period. We call it budget period. Most probably, now if we are talking about annual budgets, it's a coming year. Annual budget is 1 year. But I would say now in practice, it's not about 1 year. Maybe we are preparing budgets for a long period. 2 years, 3 years, 5 years, 10 years, maybe. But sometimes we are preparing with the changes happening in the environment, changes happening in the business, right? We are preparing quarterly budgets, monthly budgets, right? We are preparing budgets for different budget periods, not necessarily 1 year, but generally we call budget period is usually 1 year. That's how it goes. There can be changes, right? And then relationship between strategy and budget. Now I told you budget is all about business's future. It's always depends on the strategy of the business. Now what are the strategies, possible strategies there in a business? What are the strategies? What do you think? Now, if I share one example, sometimes a strategy of an organization can be to be the cost leader of the industry, in the industry, cost leader, to be the cost leader in the market. That means their strategy is to reduce the cost as much as possible and to reflect that cost reduction in the price. That means to reduce the price and to be the least price product in the market. That means the cheapest product. Cheapest product in the sense people attract. Now the product can attract people, customers, because of the low price. So low cost strategy. So that is one strategy. What are the others possible strategies? we can have in an organization? Low cost strategy and quality, obviously. Now, sometimes organizations try to introduce premium products, try to differentiate themselves from the other products in the market. That means differentiation strategy. They are different and their prices are also expensive, but still customers are purchasing those products because of the premium quality and everything. So that is one strategy. Diversification, obviously. Now, sometimes some organizations, their strategy is to have diversified portfolio in their business. Now, that is not only one industry, they are going to operate in few more industries. So that is their strategy. They are not putting all the eggs into one basket, diversifying the risks. So there can be so many strategies like that. Basically, when it comes to budgets, those budgets are linked to these strategies. Now, strategy can be there, so there we have strategy. Based on the strategy, we have long run planning and short run planning. Based on the strategy, organization has a plan, right? With the mission, with the vision, mission, objectives, and all. They have long run. Long run means more than 1 year's time. Short run less than 12 months. So long run and short run plans they have. Based on long run planning, we are preparing long run budgets. And then based on short run planning, we are preparing short run budgets. So that's how it goes, short run and long run budgets. So basically, if the budgets are prepared isolately without any connection with the strategy, that's no point of having a budget. So always, when the organization is trying to be the cost leader of the market, let's say, now give me an example for a cost leader in Sri Lanka, in any industry. What do you think? An example for a cost leader. When you hear the strategic cost leadership, what comes to your mind? A good Sri Lankan example, I would say, a local company.
Yeah, how about Unilever?
Unilever, are they cheap? Are they trying to are they trying to sell premium products with high quality, or are they trying to be cheap in the market? For some product, I would say Unilever has so many items, no? So some products, yes. But I'm saying overall, one organization, one company, one PLC. When I was learning cost leadership, that came to my mind, I would say. They want to give you the least price. They are like Aduma Milapeng. That is their slogan.
Supermarket chain?
Sorry?
Supermarket chain? That means
Yes,
maybe
one supermarket. I'm referring to one supermarket. What is that?
Oh, is it Cargill's then?
Yes.
Yeah.
What do you think? Do you all agree with me?
Yeah, they go to the source and buy the stuff, and
Exactly.
they
That is their
eliminate the
strategy.
middleman. Yeah.
Exactly. So with their strategies, they want to be the least cost provider in the market. That means the cheapest in the market. That's how they advertise. So now if we are in Cargill's, right? If we are in Cargill's, when we are preparing the budgets, don't we have to consider those aspects, their strategies? Can we just forget about organization strategy and prepare the budgets with so much of expenses categorized for advertising, paying employees very, very high salaries, and then paying a very high prices for middle persons, middle distributors? Can we do that? Can we just ignore the strategy? No. So when we are preparing budgets in Cargill's, obviously we have to always remember, keep in mind that their strategy is to have the cost at a very low level. They are trying to reduce the cost as much as possible. So that's why when you prepare budgets in your organizations, your strategy should be reflected in your budgets. You can't forget about company's overall objective, company's overall strategy, right? So what about your organizations? Are they focusing on quality and try to give a premium product? So if it is a premium product, I would say you will have to invest much in technology and then materials, I would say, because you are talking about quality aspect. So quality being having a quality product, it may be expensive. So budget is all about those expensive stuff. But if you are trying to be a cost leader, then you will have to reduce the cost as much as possible. What about your organization? What about your organization? Is your organization focusing on?
Fast service,
Yes?
the fast turnaround, short lead times.
Yes. What is your industry?
Well, I'm into labels.
Okay.
Supply mass holdings, who are sometimes not very organized and all that. So they will forget to order, but the customers themselves are asking, giving very short lead times. So then we have to be part of that team to support all the apparel industries at very short notice. So that flexibility of service should be built into the budget.
Yes, exactly. That's what. When you prepare budgets, those factors should be considered. So that's why it says budget is always linked to your strategy. You can't forget about the strategy and prepare budgets. So thank you very much for sharing your experience. I really love that. So in that case, that is how the relationship with strategy and budget works. And then, what are the different purposes of budgets? Now, these are very simple points, I would say. Planning annual operations. Obviously, when you have a budget, you can easily plan the future. In order to plan the future, you need budgets. You need a budget for everything. Like if you have now, when it comes to your annual operations, what is the quantity you are planning to do? What is the production? What about the labor requirement? What about the material requirement? What about other expenses? What about cash? Do you have to obtain a bank loan in the middle of the next year? Or will you be able to have a fixed deposit with the excess money? So it's all about planning. If you now you will be preparing a cash budget today. When you prepare the cash budget, if you have excess money, if you realize that you have excess money in next December, then you can plan to have a fixed deposit with that money or to invest that money somewhere. Or if you realize that there's a cash shortage coming next December, you can you can start the process of obtaining a bank loan. Likewise, you can plan the future rather than just waiting till December to get the things done. You can plan and always coordinating the activities. And when it comes to budgets, in large organizations, we have budget committees with maybe senior people in the organization, from CEO and all these directors and all, budget committee. And then functional managers are there: marketing manager, finance manager, research and development manager, production manager. Functional managers are there. So they are getting ready with their budgets, and then they propose their budgets in the budget committee. They have to get their approval, and at that time, centrally, you coordinate everything. You can coordinate what is happening. Now, if I just share one example, now, if the marketing manager is coming up with an idea, now next year we are going to have a new TV commercial for our products, and then it's a huge amount, and then we are investing that money, and then that TV commercial will be there. So, with that, when you increase your advertising, when you have an advertising campaign like that, your demand will increase. Probably the demand for the product will increase next year. Now, if the marketing manager is planning something like that, if the marketing manager is coming up with a new advertising campaign like that, what are the impacts on the organization? What are the other divisions that are going to have an impact? If the marketing manager is planning advertising campaign, That cannot be done alone. So what are the other divisions going to have an impact? What do you think? Yes, of course, finance. Exactly. So the marketing division cannot do their budget alone with that advertising campaign because they need the finance division. What are the other divisions that are going to be connected with this? With this advertising campaign, demand will increase. There will be more sales coming. Exactly. Manufacturing, the production division. Now, if that marketing manager's plan is not coordinated and communicated with the production manager, the production division, when the sales increases, demand for product increases, what will happen to the stocks? Will we have sufficient stocks to cater to that increasing demand? So that is a problem. So when the demand for the product increases, definitely the organization will have to increase the production as well. So that should be communicated, right? That should be well communicated and coordinated in between the two departments. Obviously the finance will have to fund these campaigns, advertising campaigns. So they will have to come up with some funding sources. So maybe obtaining bank loans or having their internal funds get ready. Likewise. So always coordinate, budgets facilitate the coordination, the communication between the departments. And of course, motivating managers to strive to achieve organization goals. Now, when you have a budget, it's like a target, maybe. Now, especially when it comes to sales budget, monthly we can budget our sales quantities, sales revenue amounts. So it's kind of a target for the sales manager, isn't it? So motivates the sales manager to achieve those numbers. I would say the quantity and the sales figures. So motivating and controlling, obviously. Now, when you have a budget, that controls you. Now, let's say we have expense budget. And line by line, let's say entertainment, that is one line item, entertainment, and there's one amount, that is the budget. Let's say 1 million, that is the budget. Now, if we are trying to exceed 1 million, that budgeted figure, there's a problem because at the end of the year or at the end of the budget period, we can always compare our actual results with the budgeted figures. Budgeted figures, actual figures, what is the variance? What is the difference? So if we exceed entertainment line item, let's say the budgeted figure is 1 million, whereas the actual is 5 million, that can't be the case. So when we have a budget, we have a limit in our organization for everything. So if we always compare our actuals, now if we have the whole amount as 1 million, up to now, how much we have taken from the budget, right? So what is left? So other than that, if we exceed the amount, there will be problems. Likewise, we have control mechanism happening, right? That is controlling activities through the budgets and evaluating the performance of managers. Now, when we compare the budgeted figures with the actual figures, always we can evaluate the performance of managers, maybe sales. Budgeted amount is 1 million, actual sales is 2 million. So performance, we can calculate the performance, evaluate the performance using the budgeted figures. So different purposes are there. So that's how the budgets are important in an organization, including the mainly planning the annual operations. Right. And then the budget period, I told you it's a selected period for which budget is prepared. If you are preparing the budget for a quarter, budget period is quarter. If you are preparing the budget for a month, budget period is month. Likewise, it can be any period any selected period of which budget is going to be prepared. And then the budgeting process. It's a lengthy process, I would say. It's not that simple as I have mentioned here. Basically, what happens is you need to well understand the organization strategy. What are the objectives that you are going to achieve in the next year? Maybe your organization is trying to have a different strategy in the coming year. So that should be reflected in the budget. that those strategies, those objectives, those policy decisions should be communicated and shared with the organization's respective managers, right? In that case, by taking those policy decisions, by taking those strategies, they can prepare their budgets, individual budgets, functional budgets. And always we can identify what are the factors that restrict the output. That is also important. No? What do you think? Do you have any factors that restrict the output of your organization? If I say like this, now, when it comes to production, in my company, my maximum capacity is 5 million products, 5 million units. There's a maximum capacity issue. There's a limitation for maximum capacity when it comes to production. Now, when we prepare budgets, if the sales team come up with a functional budget saying we are going to have 10 million units as the sales quantity, can we cater to that demand? Can we go with that demand? Can we go with that number? We can't. So always we need to understand what are the factors that restrict the output as well. In my case, the production capacity. What about your organizations? Do you have those factors as such? Factors that restrict the output in your organization, maybe bottlenecks? So those should be identified. Without knowing those factors, we can't prepare the budgets. We can't forecast the future. What is your experience? Do you have such factors? No factors, it seems. Sometimes prices can be there. Sometimes material, staff constraints. Sometimes we are having issues with finding trained employees, right? Trained, now labor hours. There can be maximum capacities with labor hours. System capacities, obviously. Cash issues can be there. Like our company is not in a position to obtain bank loans or anything, so we can't expand our business anymore. We have to wait a little for the next year. So funding issues can be there. Factors that restrict your output. Likewise, I said production capacity issues can be there, system capacity issues, staff constraints can be there, right? Those are issues. And then material constraints. Now, we are using a very rare raw material for our production. Now, in that case, we can't expand, or we can't increase the production because we are having problems with finding that rare raw material locally. We are exporting or exporting is also, importing is also not a solution for that sometimes, right? In that case, we have issues. If we can't export our products, again, we can't sell. Even though we are planning for 1 million, we can't sell that. We don't have that sales capacity. We don't have distribution vehicles like that, right? Those factors should be considered when preparing the budgets. That is very important. So practically think about your organization. When you prepare budgets, when you think about your budgets, what are the restricting factors in your organizations? That is important. And then usually we start our budgets with the sales budget, because that's in the end, that is the ultimate objective, to increase the sales, right? So we plan everything most of the time. There can be changes. Most of the time, we plan our budgets based on the sales. How much of sales we are going to make in the next year or next month or next quarter? What is the quantity? Based on that, we plan our production. Okay, if the sales is going to be 1 million units, what should be our production? If our production is going to be maybe 1.2 million units, what is the material requirement? What is the labor requirement? Likewise, we are planning backwards. That is how the normal process goes. There can be changes in different organizations, but sales budget would be the first budget we prepare in a normal organization, very ordinary organization. Right? So this is how it goes. Basically, prepare the sales budgets and then other functional budgets. As I mentioned, production budget, manufacturing overhead cost budget, labor cost budget, expenses budget, likewise. And then preparation of the master budgets. When we have all these functional budgets coordinated and fine-tuned and approved, we can have the master budget. We take everything together. Maybe we can prepare a budgeted P&L and a budgeted balance sheet, right? By taking everything. We have the budgeted sales, we have the budgeted production, we have budgeted expenses and all. So we can prepare the budgeted P&L and budgeted balance sheet, right? So master budget, we call that. And then negotiation of budgets with the superiors, of course, maybe with the budget committee and all. And then coordination and review. There are so many reviews. There can be so many factors to be considered. Now, in the Sri Lankan context, when you prepare budgets, at the moment, there are so many issues. We don't know. It's very difficult to predict the future. Interest rates, exchange rates, in a volatile situation. What about COVID-19 pandemic era? It was very difficult, isn't it? So the coordination and review of budgets, final acceptance, and then ongoing review of budgets. Now, I will explain later. Budget is not about one-time activity. It's a continuing process, and I'll show you that example in the when you go along with the slides. So basically, that is the normal budgeting process in an organization. Do you have any different ideas to share when it comes to your organization's budgeting process? Is this the process you follow, or if you are directly involved in budgeting?
Yeah, Natasha, this
Yeah.
the preparation of the sales budget. I think
Yes.
after preparing the sales budget
Hmm.
based on strategies and all that,
Hmm.
I think we have to do capacity planning, because if
Yes.
we don't do capacity planning, we can't go to the functional budgets.
Yes.
For instance, I
True.
mean, very right. Like, I mean, in Sri Lanka, we have a restriction about working hours, right?
Yes.
Right. We also know our machine capacities. So, I mean, we add let's say we add a percentage for wastage,
Hmm.
normal waste, we can add a percentage for normal waste only.
Hmm.
We can't charge the cost of abnormal waste to the customer. It's our
Yes.
fault. So we put the normal waste, and then we arrive at the units. And
Hmm.
the units have to be fed into the machines. Look at the machine capacity. So
Hmm.
we have to buy additional machines. Then based on the certain machines, one-to-one labor.
Hmm.
So then we work out the man hours, and then we have to see whether we have to do overtime. All within that gambit, the working hours limitation, right?
Yes.
What is
That
permitted
is,
in
you're
law.
referring to these factors that restrict your output, isn't it?
Yeah.
Yes.
So after preparing of the sales budget, we do the capacity planning. We spend a lot of time on capacity planning.
Exactly.
And the finance department presents the capacity plan for discussion before we proceed any further.
Yes.
That's quite significant.
Yes, exactly. Thank you. Now, after identifying your capacity issues, like we mentioned, the factors that restrict the output, that is like determining. And then preparing the sales budget. You mean before going to functional budgets and all? Maybe yes, capacity planning is important. Now, this is like a very simplified process. No, absolutely true. I agree with you. So that is important. So that is the most important aspect as well. If you don't do the capacity planning, as you mentioned, if you don't identify the factors, if you don't identify your material issues, everything, you won't be able to go with other budgets and finalize budgets. Even though you finalize your budgets, you won't be able to operate those budgets in the organization in the real world situation. So that's why that's very important. And new customer acquisition is also considered, and growth percentage will also be added. Exactly. Very, very good. So all these factors should be considered. Here, factors that restrict your output. And then there are different ways of doing budgets as well. Sometimes we are using incremental budgets. That means you take the last year's budget and then you are adding for inflation, you are adding something for your growth of your organization. Likewise, you are changing numbers based on the future predictions, and then you are increasing the numbers, incremental budgets. So have you done incremental budgets in your organizations? Or I will explain the next one as well. Or zero-based budgets. Zero-based means you are starting from the very beginning. You are not referring to the previous year's budget. You are starting a very fresh budget for the year. So that is difficult, I would say. All the line items, all the things should be thought carefully. You are starting from zero and then preparing the budgets. So what is your approach in your organizations? Zero-based budgeting or incremental budgeting? Incremental. Yes, incremental. That means you are taking your previous year's budget and then you are adding, you are accommodating, changing few things. Any zero-based budget preparations?
I think it has to be a combination, because if there is a
Mhm.
product launch, it would be obviously zero.
Mhm.
So you start up a new production unit, so it has to be zero base.
Yes,
But
zero-based, new projects.
yeah, new product, new process, everything.
Exactly. If you are starting a new business, obviously that is zero. In the same organization also, while you are doing for your annual regular processes, you can use your incremental budgets. Now, I was working at MAS before I joined as an academic. Now, there I was part of the budgeting team, and then we usually do incremental budgets. We did incremental budgets for our customers because we know them and we know the process and we know the growth percentages and all, and we know the issues that is going to be addressed in the next year. By combining everything, we do the incremental budgets. Incremental doesn't mean always increasing, I would say. Sometimes we are doing changes, sometimes we are reducing the amounts, everything's happening, but incremental. Based on the past, we do the future. But I was involved in new customer. We onboarded one new customer at MAs, and then for that we don't know anything. So we had to start from the beginning. And then I can remember we started a new factory, right, for femtech products. So in that case, we had to do zero-based budgeting. So in the same organization, for regular processes, you may have done you can do incremental budgets. Sometimes it is zero-based budgeting. So as you have correctly mentioned, for new projects, exactly, zero-based budgeting. So those things are there. And there's one another way of doing thing, rolling budgets, continuous budgets, but I explain that later with some example, right? So those are different ways of doing budgets. There are different approval processes. There are different processes in organizations also. They have set their process, how to do the budgets and all. So likewise, we can do, right? And then this is like relationship among budgets. Now, if we have the company's objectives, policies, current year's figures, and always look for the industry, the futuristic future predictions. After forecast, sales forecast, and then we prepare the production forecast. If the limiting factor is on the production side, these are reversed, right? Now, as I mentioned, factors can be there to limit your production. Maybe labor hours, maybe material availability of your materials. So sometimes we start with the production and then we plan everything accordingly. There can be different changes in your organization as well based on the nature of your business. So likewise, we prepare sales budgets, we prepare production budgets, admin budget. Admin budget means administration expenses, research and development budget. And this is also very important. I'm not going to prepare this budget today. Capital expenditure budget. What do you mean by capital expenditure budget? Usually we say CapEx budget. What do you mean by capital expenditure budget? Any idea?
Yeah, any expansion of production capacity in the form of fixed assets, machinery, plant, even space.
Yes, CapEx, everything. Fixed assets. especially property, plant and equipment. CapEx means PPE. So if you are putting up a new factory, if you are purchasing new machines, if you are purchasing new equipment, computers, furniture, all these fixed assets, you need to have this CapEx, or even for intangible assets like softwares and everything. So CapEx is all about purchasing fixed assets, not only purchasing. If you have to remove old machines and everything, you have to incorporate those aspects into the CapEx budget. So it's a very expensive and a very important aspect, I would say. Now, when I was at MAS, if I share my experience, there were so many divisions, there were so many factories, and then there were maintenance division. Now we have to now how this happens. Basically, we are centrally preparing the capex budget, but plant wise, the factory wise, and then small organization wise, they are sending their requirements. For the next year, we are introducing a new product, so we need this machine. Likewise, we need 50 items from this one for factories. Likewise, plant wise, we collect information. So there's a specific information collection process. And when they are sending their information, they have to get their factory managers and higher ups approval. After identifying, we get the numbers. And then centrally, we look at, okay, this factory requires these machines this much. This is the quantity. Likewise, we centrally match everything. It's a significant process. Like we centrally match everything, the requirements, whether we can now at that time, when it comes to a business, let's say factory A and factory B, there are two factories. Factory A needs one particular machine during January and February. Their production, January and February, this is the quantity. But after that, the based on their order scheduling, they are getting their numbers with those capex items based on their orders, basically, right? The orders they are going to fulfill in the next year. Now another factory might need the same machine maybe in December. I'm just giving you an example. If it is feasible, if it is operationally practical, sometimes we can shift those machines to that nearby factory B. So likewise, we don't have to again purchase the same machines, the same quantity for factory B in December. Likewise, we are matching these requirements. We are putting so many adjustments to the numbers. We renegotiate with the factories and all, and then we finalize the capex budget. So that is also very important, coordinating, right? That's why we always have a master capex budget. If they come up with their factory capex budgets alone and get the approval and do the purchasing, then we can't match the requirements. So that's why coordinating is important. So likewise, our capex budget is one aspect. And then coming under sales budget, based on the sales budget, selling and distribution budget, those expenses, because based on the sales, selling and distribution budget, that expenses are very related. And then based on the materials, production, how many units we are going to produce in the next year or next month, we have to come up with the materials budget. What are the kilograms? What are the meters or liters we need from each and every raw material? And then the labor budget. How many labor hours we need? How many trained labor hours? How many untrained labor hours? Likewise. And then the expenses budget. Master operating budget. We combine everything and preparing one master budget. And then there are so many other budgets, stock budgets, debtor budgets, creditor budgets, cash budgets. And then look at the arrows coming to cash budget. Cash budget is linked with the research and development budget, capex budget, expenses budget, labor, material, selling and distribution. So everything is linked to the cash budget, right? So likewise, you prepare so many budgets, and there can be so many other budgets in your organization as well. This is just one illustration, normal budgets. You can have different names, you can have different ways of preparing the budgets as well, right? Okay, and now we are moving to, now I have selected, now as this is a short course, I have selected a very simple activity, right? But in your organization, the budgeting process can be much complex. But I'm taking one activity, and to refresh your fundamentals, the knowledge on your fundamentals, we will be preparing these sales budget and then the production budget. Here, the assumption is we are preparing the sales budget first. Based on the sales, we are planning the production. How many items you are going to sell? Okay, if we are going to sell this much, what is the quantity we have to produce? Production budget. If you are producing 1,000 items, what is the direct material usage? How many kilograms we need to do that production? How many liters of material we need to do that, to accommodate that production? That is direct material usage budget. And then based on the usage, we can purchase direct material purchases budget. If we are going to use 1,000 kilograms of this material, what is the quantity we need to purchase? Likewise, right? Direct material usage, direct material purchases, and then direct manufacturing labor cost. If we are going to produce this many units, what is the direct labor hour requirement? What is the cost? What is the hourly rate we are going to expect? Likewise. And then manufacturing overhead cost. Now we know manufacturing overheads and everything. We learned activity-based and traditional absorption costing. So manufacturing overhead cost budget. And then non-manufacturing cost budget. What do you mean by non-manufacturing overhead cost? Give me another name for this. We have discussed this. Non-manufacturing overhead cost budget. Admin, or not only admin, what are the other things? Admin, selling, finance, and other expenses. Exactly. Yes. Expenses budget. So we might not use the word non-manufacturing overhead or non-manufacturing cost budget in your organization. Sometimes we might use expense budget. So we have all the expenses possible under different types, and then we budget for the next year. And then we have finally the cash budget. So these are the only budgets we are going to prepare, right, with the time constraints. But I'm repeating, there can be so many changes to these budgets. There can be so many other budgets in your organization as well. Right. So we'll go to the activity. I have shared the activity. Right. Now, before going to activity, since I opened this one, the recommended text, I would say. So I have shared these recommended text, and then I have highlighted important areas. So when you have a some time, just spend some hours on this one and read the fundamentals. It is good, right? It's a good recommended text. So what is strategy? What is budgeting? And then what are the functions? They explain very well the functions, and then the budget period, and then administration of the budgeting process, the budget committee, what is the role of the accounting staff. Now, as I told you, functional budgets are prepared by functional managers, but the accounting staff will normally circulate instructions and offer advices about the budget preparation. So that is why accounting staff is having a major role to play when it comes to budgeting process. They have to combine everything and prepare the master budget as well. And then it explains this example, right? I'm anyway explaining that. The one by one sales budget, production budgets, direct material usage, direct material purchases, direct labor, production overhead, selling and admin budget, departmental budgets, master budget. See, I'm not explaining the master budgets, not doing the master budget to this, but you have this budgeted profit statement, profit or loss statement, and then budgeted balance sheet. You have everything. And then cash budget, of course. I told you cash budget is linked to all other budgets. So the cash budget, and always computerized budgets. Those are very important things, right? Computerized budget and activity-based budget. What do you mean by activity-based budget? Now, you learned activity-based costing. Instead of parking the manufacturing overhead cost to departments, you can have activities. You can have your cost marked as activities, maybe cutting, sewing, and maybe production scheduling. So you budget your cost based on the activities, activity-based budgeting, from activity-based costing to activity-based budgeting. And then you have this budget process in non-profit making organizations. If you are coming from a non-profit making organization background, you can read this one. Line item budgets applicable to those organizations. And then zero-based budgeting. As I explained, start from base zero rather than last year's budget. And then criticisms for budgeting. I'm not going to touch on this area. What are the criticisms over budgeting? Read this. And then beyond budgeting, new concepts. And then surveys related to criticism of budgeting. Likewise, you have so many information, so you can have a look at this chapter as well. Right. So we'll go to the activity. I hope you have also opened the activity. Just have a look at the activity 1. Right. So shall we have a look at the activity 1? Now there's a small correction. The activity I have shared with you, I have not made this 2025. So make it as 2025, but in the slides, 2025, it should be. So the company has produced a plan for its activities for the last 3 months of 2025, I would say. So what is the budget period? We are preparing the budgets for last 3 months of 2025. That means October, November, December. Right. And then we have been given the sales numbers. The company's forecasted sales for the next 6 months are as follows. So that means October 1000 units, November, December, January, February, March. This January, February, March is 2026. For the next 6 months, they have forecasted the sales. Now, even though we have been given these sales numbers very easily in a table, this is kind of very difficult task to forecast the sales numbers. Even though we have been given the details very easily, this part is very tough, I would say. Now, as we explained, with the limiting factors we have in the organization, forecasting the sales would be very tough, and then numbers have been given. So remember, even though the numbers are there, that part is very tough in order to prepare the budgets. And then it says 40% of the monthly sales will be for cash, and the rest 60% will be for credit basis. That is there. We have both cash sales and credit sales. And then we have the selling prices given. For cash, 1,500. For credit sales, 1,520. We have 2 numbers there, 2 prices there. And then material and labor requirement. Usage per unit. That means to produce 1 unit, you need 3 kilograms of direct material. What is the rate? Rupees 100 per kilogram. What about direct labor requirement? 2 hours. What is the hourly rate? 60 rupees. And then manufacturing overhead costs are absorbed into the product on the basis of direct labor hours. Based on the direct labor hour consumption, we are absorbing manufacturing overhead cost. The absorption rate is 40 rupees per direct labor hour. That is their OAR, overhead absorption rate. So that is computed and given. But in the real world situation, you will have to think about all these things, right? And then non-manufacturing overhead cost, sales commission paid for sales on cash basis. For each and every sales unit, you need to pay 5 rupees. And then fixed cost per month, admin 30,000, depreciation 8,000. And then stocks. Now here, this is important. I want your experience as well here. When it comes to stocks, you have 2 types of stocks in this example. We have raw materials and we have finished goods. When it comes to raw materials, a stock of raw materials required for the half of the next month's production requirement will be maintained. What do you mean by that? Stocks, that means let's say October closing stock of raw materials, a stock of raw materials required for the half of the next month's production requirement. That means you have to have an idea about November production requirement. From that production requirement, half of the requirement, that means half of the material requirement, should be kept, should be maintained as October closing stock. Right? At the end of the October month end, we have to have a balance equal to half of the next month's production requirement. And then what about finished goods? Finished goods equal to the next month's sales will be maintained as stock. So October closing stock of finished goods should be equal to next month's sales. So the quantity required for next month's sales should be maintained at the end of the previous month. So October end closing stock should be equal to November sales requirement, November sales quantity. So likewise, you have conditions. Now, these are very simplistic conditions, I would say. What are your real world examples now? What is your experience in those things? What is your policy? So these are conditions or policies in organizations. What about your organization? Do you have conditions like this? I'm repeating, these are some very basic, simple conditions. But what about your organizations? What is your policy, stock policy? Maybe for raw materials and maybe for finished goods.
I think your sourcing lead time, including transit time, has to be bearing in when deciding how much stock you're going to carry.
Yes.
Just a small question. I mean, I'm just thinking forward. Now, when it comes to raw material and finished goods, okay, quantities, we can budget for the quantities, but when it comes to valuation, right now, raw material, it means that if you're maintaining, let's say, 1 month stock or half a month stock, that means there's a fast turnaround. So,
Yes.
like, okay, we go on first in, first out, and then the valuation we take as the weighted average. Likewise, when it comes to finished goods, I like to know your ideas about how that should be valued, because ultimately finished goods it's based on customers' requirements that we would maintain finished goods. Yeah, I like to.
Yes. Now, in this example, this is a very simple example. No, this example, it talks about a very standard product. That is the first assumption we have to make. We are talking about a very standard product. We are not customizing. That is very standard. And then when it comes to inventory valuation, can you remember the fact we discussed? When it comes to inventory valuation, as per LKS2 inventory standard, always we have to consider only manufacturing cost. Only the manufacturing cost. That means direct material, direct labor, direct other, and then manufacturing overhead. Those are the cost items we are going to add into material stock valuation, closing stock valuation. That's why actually it's mentioned finished goods are valued at prime cost. Prime cost means all these direct expenses and then manufacturing expenses, right? So when it comes to organizations, when it comes to valuation, when it comes in the budgeting process, now we have not produced. We are talking about the future and we are getting the numbers. We say we need 1,000 units as the closing stock. Based on the budgeted numbers, we will learn in the next lesson standard costing. We have standard costing. That means we have a standard requirement for material. Here also we need 3 kilograms of this particular direct material to produce 1 unit. We need 2 hours of this particular direct labor type to produce 1 unit. And we have standard rates as well. Now, obviously, the future prices, there can be changes, but we have a standard with the past information and the future discussions we have made with the suppliers. Now we know 100 rupees per kilogram, 60 rupees per hour. So in that case, we have a standard set for direct material cost, for direct labor cost, direct other cost, and always manufacturing overhead. There also we are pre-calculating the overhead absorption rate. No? So we know the direct material cost. There can be changes, but we know the cost. And then direct labor cost, direct other manufacturing overhead cost. We take all these items together and then we multiply by the quantity and get the value. So that is how we take the value of stocks, right? When it comes to the valuation. Here in this budget, we are not talking about the valuation. That will be important when we are preparing the stock budget. And also that will be important when we are preparing the master budget, that is the budget, that means master balance sheet, right? So we have to value the inventory there. So in that case, we are talking about those standard costing methods and to value them, and then based on that, we can value the inventory. So that is how we value inventory. Raw materials also, raw material stocks we are maintaining, that means it has a cost. Basically, it is the purchase price. Standard purchase price, we know. Here, in this example, we are not considering that valuation, but definitely your question, you will need that valuation for the budget of balance sheet, and then always the stock budgets. So are we clear? And then just to clarify another thing, now let's say you have decided now manufacturing overhead cost. You have decided based on your overhead absorption rate, this is the amount, 40 rupees per hour. That is your standard OAR, or overhead absorption rate. And when you actually do your production and actually sell your products, and after 1 year's time, maybe when you calculate and see, you have 50 rupees spent for 1 hour. When you consider all these actual electricity bills, actual water bills, actual rent, actual cleaning staff salaries and everything, when you calculate and see the actual amount you have spent for 1 hour, it has become 50. Whereas you have budgeted only 40, right? 40 became 50. What about this difference? How do you address this difference? Now, in the stocks, you have absorbed only 40 rupees as the manufacturing overhead cost based on your standards. But when you actually calculate and see, it has become 50. What is your difference? What do you do for this difference? What is the treatment for this difference? Basically, we treat this difference. If it is like 40 we have absorbed to the inventories, but we have spent 50 rupees. That means you have spent 10 rupees extra that you consider as an expense. Maybe other expense. There are different ways to related accounting treatment, but expense, you have expense that. Maybe you have standard, as per the standard, you have absorbed 40 rupees. I'm talking about manufacturing overhead. And then you have actually, when you actually calculate, you have spent only 35. 40 is the standard, 35 is your actual, whereas you have absorbed more, 5 rupees more. That would be kind of a gain for you, kind of a gain, it kind of an income. So you treat this, you record this gain or the expense in the P&L. That's how you adjust. So you have adjustments coming when you have these numbers. So did I answer your question, the inventory valuation?
You did. We actually prepare quarterly. We
Yes,
have what's called
explain,
annual
please.
budget.
You can share. Yeah, annual budget.
We have the annual budget, but we flex it to quarters. So every quarter we review and we adjust. Because the logic being, it's very unfair for us to charge to the customer our sins, our bad planning or anything like that. So this is what I mentioned at the start, that capacity planning is important, right? So our absorption rates would be very close to accurate.
Yes.
Because we won't over-absorb, right?
Yes.
We won't. So it's a very dynamic process. So Yeah, so you asked me about raw material valuation. Yeah, because we maintain because of short lead times and the high consumption, we would value at we go on last in first out and value at weighted average, the raw material added cost. It is the percentage, the weighted average on that.
Right. Okay.
Yeah.
Now, I think you are talking about rolling budgets. You said you are preparing the budgets for one quarter, and then you are adjusting the next quarter if there are any changes happening. Am I right?
No, for management accounts, it's an annual budget.
Right.
But for strategic reasons, because of the rapid changes in the market, we do a quarterly review, and we keep on we'll update the next quarter's budget.
Yeah.
If necessary, we do the adjustments. Yeah.
Yes, that's called actually now annual budget. That's true. That's called actually rolling budget technique. I will show you. Now, this is quarter one. This is quarter two, quarter three, and then quarter four. We prepare this. This is annual budget now coming from January to December. This is like annual budget. We prepare this budget first. And now let's say this is 2026. This whole year is 2026. Now we are in the quarter one. Now we have the budget for the next 12 months. That's okay. Annual budget is done. We are in the quarter one and we see some changes are happening in the next quarter. Maybe prices are getting changed, interest rates are getting different rates with the government changes. Likewise, we are doing changes to the second quarter, right? Second quarter. Now we are at the March end maybe. So we are here at the end of first quarter. And now we are doing some changes to quarter two. And again, we are adding another quarter. This is, I think, I don't know whether you are doing this one. Quarter five. Or I would say quarter one of 2027. You are adding another quarter like this. And you add the next quarter to your budget. So when you reach April, how many months are there in your budget? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So basically, this is like there are two aspects to here. Just forget about adding the next quarter. Here, while you have prepared annual budget, even though you have approved and everything, quarterly you review the numbers and do the adjustments. I think you are doing that aspect. Am I right? Even though you have the budget, you do the adjustments in the budget to reflect the current conditions. Correct. And then another aspect of this is, now by the time you reach April, this quarter one is gone. It has become past. At that time, you can add another new quarter from 2027 and you are always maintaining a 12 months budget. You are always maintaining a 12 months budget, but quarterly you are adding quarters. When you finish one quarter, you are adding one quarter. So always you are budgeting. It's a continuous process. You are always thinking about the prices. You are thinking about the changes going to be happened. So likewise, this is kind of a rolling budget, continuous budget. So there are two aspects. Adding one quarter is one thing. Changing your current quarters is another thing. So those are also there. I think it's one part of it has been done in your organization. Changing the quarters. Even though we say previously, when we prepare the budget, that is fixed, we are not going to change any number. But now it's not the case. In this VUCA world, in this volatile environment, we have to change these things in order to reflect the correct situation, most accurate situation. So you can change the quarters. Exactly. Mid-year budget review. They are also, you're changing the next 6 months. No? So that's how. Previously, those concepts were not there. But now, with the changes happening, we are doing it. We follow forward sales. Therefore, over the period of time, the required quantity will be purchased until the production starting date. Yes, that's also good. Until the production starting date, you will be that is one condition, right? We were talking about stock conditions. No, that is one way of doing, one way of planning your stocks, right? So that is one another thing, rolling budgets. So we were talking about different types: zero based budgeting, incremental budgeting, rolling budgets. Those are new concepts, right? Okay, now we'll go back to the activity. Now, that is stocks conditions for raw materials. You are keeping half of the next month's requirement. And for finished goods, you are keeping stocks equal to the next month's sales requirement. And then look at purchasing and selling conditions. Payment for raw materials are to be made on average 2 months after the delivery. That means you are not paying cash to your creditors or the suppliers. You are making the payments after 2 months delivery. And then debtors. Now you have both cash sales as well as credit sales, isn't it? So when you have credit sales, that means you have debtors. Debtors will pay their dues as follows: 50% of the sales value during month of sales. That means if you have done uh, October credit sales, 50% of it you will receive during the particular month. 30% of the sales value during the following month. 30% of it you will receive in the next month. Balance 20% you will sales value during the second month of the sales, the next month. Likewise, 50, 30, 20. Now here also, this is only very simple example. In your organization also, when you talk about cash flows, when you talk about your cash budget, you will have to consider these things. This is a very important aspect is missing here. I have not included that. What is that? Can you exactly consider the debtor amount as a future cash receipt? Will you be able to receive all the amounts due from debtors? Or no, exactly no. So you will have to allow for bad debts as well. So that's why you have receivables provisions, right? Bad debts. So if you are with the experience in your organization, with the current information you have, if you predict that 50% or no, not 50%, 10% of your receivables will be bad debts, that you need to keep that in your mind and then you have to allow that. You are not going to receive cash for this much, for this amount, 10% of your receivables. So you have to think those important facts as well when you talk about the cash budget. And then other payments, direct wages are paid during the month in which they are incurred. And then fixed overhead is incurred in equal amount each month and is paid in the month which they are incurred. Can you remember the fixed overheads we have? We have these non-manufacturing overhead cost. We have 5 rupees sales commission and then fixed cost, admin cost and depreciation. So those are equally happening every month. Manufacturing overhead includes 30 rupees of fixed machine depreciation each month. That means you have manufacturing overheads here, 40 rupees per direct labor hour. That is overhead absorption rate. When it comes to overhead, manufacturing overhead, you have so many things, no? Electricity, water, rent, training staff salaries. And another important thing would be maybe machinery depreciation. Depreciation is also one expense. Is it a cash flow? Is depreciation a cash flow, cash outflow? What do you think? No, depreciation is not a cash outflow. So can you include that in cash budget? Can you include that in the cash budget if it is not a cash outflow? No. So likewise, you need to think of those aspects as well, right? So in your organization, there will be so many other things, non-cash elements. So you have to think about non-cash elements included in the expenses, right? And then all other manufacturing and non-manufacturing costs are paid during the same month. And this one, actual credit sales details for the month of July, August, September 2025 are as follows. That means what are the actual sales, and then what are the direct material purchase details. Now I'll come into these two tables later. First, we'll prepare the budgets based on this activity, right? So I hope you have the activity sheet template with you. To save time, actually, I have prepared the budget structure and I have shared with you. So I want you now, it's better if you can use Excel actually. No point of doing it manually, no. In these organizations also, you are using Excel or any other softwares for budgeting now. So with the functions, with the formulas, we can directly arrive at these numbers if you are using Excel. So I want, now we have read the activity and I have sales budget, production budget, direct material usage budget, direct material purchases budget, direct manufacturing labor cost, manufacturing overhead, non-manufacturing overhead, and finally cash budget. For cash budget, we have two workings. Don't look at the workings now, we'll discuss. But these are the budgets we are going to prepare based on this activity. So let's have a small break. But meantime, if you can try to put the numbers into these budgets and get the numbers with the values, that would be great. So we'll have 10 minutes break. We'll start at 9:58. We have to finish by 11. So we have 1 hour to discuss the budgets. But meantime, if you can, just try to get the numbers into these budgets using the Excel, right? So let's meet at 9:58.
Natasha,
Yes.
yeah, there's a personal thing.
Yeah.
I missed last week's lecture. Actually, my mom passed away.
All right.
And can I have the lecture materials? Can I have access to
Yes.
that?
Didn't you get the lecture materials from CMA email? But I can anyway email, but I'm just wondering whether you didn't get.
No, I could not download. I don't know what it was.
Right. Okay, I can share.
I don't need I don't, just the material is fine for me to just go through, browse through.
Okay, right.
Please.
Anyway, I'll
If
ask
you
them
can
to
send it
share
to my
the video
email.
recording as well. Yes. Can you please drop a text in the chat box? I can email.
Okay. Okay, I'll do that. Yeah.
Yes. Okay.
Okay.
That's great. Right. Okay, so let's get with the answer. We'll do the answer for activity 1. Right, so I hope you have gone through the activity and then you have started doing the budgets. Right, now, as I explained you earlier, there can be so many changes, there can be so many complexities when it comes to real-time budgeting, real organizational budgeting, but this is just one simple example. So this is very straightforward, I would say, but it won't be the case for organizational actual budget preparation. But we will be touching upon the fundamentals. Right, so that's why we are starting with the sales budget. There can be different changes to this as well as the first step based on your limiting factors. Here we are talking about the sales. So sales amounts have been given, right? The company's forecasted sales for next 6 months given, and that is October, November, December, and then yes, October, November, December. Because what is the budget period? We are preparing the budgets for the last months of this 2025. So we are coming October, November, and December. Now, when you prepare these budgets, now based on the conditions we have, actually I have taken 1 month addition. Additionally, I have taken 1 month as January, right? I'll tell you the reason and you will realize why I have taken 1 month in addition to October, November, and December. So for now, we will prepare the budgets for 4 months. Even though our budget period is 3 months, we will be preparing the budget for 4 months. Let's get the numbers here. So sales budget, that means you need to come up with the sales quantity that is already given. And then based on the prices, budgeted prices, we are going to have the sales revenues as well. Exactly, yes. Your reason is correct. So sales budget, we have the sales numbers 1,000, 1,200, and 1,500. 1,000, 1,200, 1,500. I'm getting the units. And then for January, it's 2,000. So I'm writing the numbers. And then we can't directly multiply this quantity with the price because we have 2 prices based on cash and credit. So I would say 40% sales cash, rest 60% on credit. That means I'll be getting the numbers separately for cash and credit like this. Give me a moment. Right. So 40% would be cash. So I'm applying a simple formula multiplied by 0.4. So I'm just copy pasting the numbers and then credit 60% multiplied by 0.6. Likewise, so this is tallying to 2,000. And then selling prices for, now we can have the selling prices as well. Selling price is cash sales 1,500 cash basis. So it is the same. Now sometimes in your organization, there can be price revisions, maybe in December, maybe in November. So you have to multiply it by the correct price, I would say. And then the credit, 1,520. It is the same in this example. And then we can multiply the quantity by the price and get the sales revenue. So cash basis 1,500 price multiplied by 400, 600. Copy pasted the formula. And then for credit, 1,520 price multiplied by the credit quantities, 912, like this. So I'm just taking the totals of both cash and credit sales. These are the amounts. Any one of you did the budgets before the class or while doing with me? Do you have the same numbers? Anyone? Yes, thank you. Right. So always if you are using Excel, if you are using Excel in your organization, always use functions and all, right? It's always easy to do budgets with functions. If you are using any softwares or anything, that's fine. That's totally okay. That's great. But if you're using Excel, always get the constant numbers and then you can multiply with the variables. Always use functions, Excel functions like this, right? Okay, now we are done with the sales budget. In the sales budget, what you show is the sales quantity you are going to sell and then the sales revenue based on the budgeted prices. And then based on the sales, we are calculating the production budget. We are doing the production budget. If you are going to sell 1,000 units in October, what should be the production? What should be the production? Right. Now, first of all, we are taking the base sales forecast. I'm just taking the number 1,000 in October and then 1,200 in November and then 1,500 in December and 2,000 in January. So that is the sales requirement for each month. Now my question is, now since you have the format, you have the answer. My question is, now the sales quantity for October would be 1,000. If we manufacture 1,000 units, sales quantity is also 1,000. If you manufacture 1,000 units, would that be enough? Would that be enough? Based on our sales closing stock conditions. Now, what is the condition we have? For finished goods, what is the condition? We have to maintain a stock equal to the next month's sales. We have to maintain a stock equal to the next month's sales. So in that case, if we manufacture 1,000 units, that won't be sufficient because we need to maintain next month's sales as well at the end of October. How do you do the adjustment? So basically what you do is your sales requirement is 1,000 for October, plus you need to manufacture your closing stock. Plus you need to manufacture your closing stock equal to next month's sales. What is next month's sales? For October, 1,200. That is the November sales. So you have to have your 1,000 units ready, plus next month's sales should be ready. That is 1,200. So I'm directly linking 1,200 here. What about November? What about November? At the end of November, you need to maintain a closing stock of finished goods equal to December sales, 1,500. What about December? You need to maintain a stock equal to 2,000 January sales. What about January? What about January? What should be the January closing stock? What should be January closing stock? January closing stock should be equal to, yes, yes, Manjula, out of budgeting period, that's correct. But I told you, when we are preparing the budget for, even though we are preparing the budgets for 3 months, last 3 months of 2025, I'm just adding one column. I will explain the reason. I'm just adding one column. I'm just doing one extra month, right? That's why. So at the end of January, what should be the closing stock? My question. Exactly. January closing stock should be equal to February sales. February sales. So how much is February sales? It's given 2,500 February sales. This is the February sales. So I'm just adding by looking at the table 2,500. So now do you get the point why they have given January, February, March sales quantities as well? Because they are stock condition. Because of their stock condition, we need those information into the budgets. Right. Okay, now my question. October, the sales quantity is 1,000 that you know. And then October closing stock equals to next month's sales, that is 1,200. There also you added that. You added that. Altogether, what is the quantity? Altogether you have 2,200. Now, do you have to manufacture 2,200 units in October? The condition was you need to keep a quantity equal to next month. So you manufacture 2,200. Do you have to do that? Do you have to manufacture 2,200 units in October? Or don't you have an opening stock? Don't you have an opening stock? And can you reduce the production quantity by that opening stock? Do you have to manufacture 2,000? Exactly. Answers are correct. Now, even though 1,000 is the sales quantity, 1,200 is the next month sales quantity, even though the number is 2,200, you don't have to manufacture 2,200. Why? You have an opening stock as well. What is October opening stock? What is October opening stock? October opening stock means September closing stock, isn't it? October opening stock means September closing stock. What should be September closing stock? September closing stock should be October sales. October sales. How much is October sales? What is the quantity for October sales? 1,000 units. 1,000 units. Then what should be October opening stock? 1,000 units. 1,000 units. So my argument is, since you have already 1,000 units in your hand, in your organization, you don't have to manufacture 2,200 units. You can deduct that 1,000 units. So this 1,000 you can deduct. You don't have to manufacture this 1,000 units. Exactly. Answers are correct. Very good. So in that case, what is the quantity? Final production quantity in units? Only 1,200. Only 1,200. So are you clear with those logics? Even though that logic is very simple here, you will have to apply these things, similar things in your organization as well when preparing budgets. So are you clear with those things? Are you clear what we did here? Okay, hope yes, right. So I'm moving on to the next month. What about November opening stock? So basically we deducted the opening stock, right? What is November opening stock? November opening stock is previous month closing stock. November opening means previous month closing. Previous month is October. What is October closing? October closing equals to this one. October closing 1,200. What about December opening stock? What about December opening stock? December opening means November month closing. So November closing is 1,500. What about January opening stock? January opening stock means December closing. December closing stock. Likewise, you get the numbers. See, it's easy when you link. It's the other pattern. And then you get the final production quantity as this 1,200, 1,005, 2,000 and 2,500. Are you clear? Any doubts? Okay. And then now we have prepared the sales budget. Now we know the production quantity, how many units we need to manufacture each month. And now, based on the production, we can budget our direct material usage. How many kilograms of raw materials we need for the production. So based on the production, so I'm taking the production quantities linked like this, Control C, Control V. And then per unit, how many kilograms we need? Look at the question. How many kilograms we need per unit? 3 kilograms. So I'm putting 3, 3, 3, 3. So even though it is fixed here, sometimes in your organization, there can be changes. Maybe with the efficiency targets, you are reducing the quantity. So in that case, what is the total quantity you need? For this production, you need 3,600. For this production, you need 4,500. Likewise, you get the quantities. What are the raw material quantities you need? Direct material usage, right? And then based on the usage, now you can decide how many kilograms we need to purchase now. Now, if you know the requirement, now the next step is to purchase. So how many kilograms you need to purchase? Again, starting with the usage, right? Getting the same numbers. Then again the same logic comes here. You understand, you have realized you want 3,600 kilograms for October. You need 3,600 kilograms for October. But is it enough if you just purchase 3,600 kilograms? Or do you have to maintain a stock of half of the next month's production requirement? You need to maintain a closing stock as well. If you just purchase 3,600 kilograms, that won't be enough. You need to have a closing stock as well. So what should be the closing stock? What should be the closing stock? Half of the next month's requirement. Half of the next month's requirement means what? Can I have just October number? What is October closing stock? Half of the next month's requirement. Exactly. It is 2,250. How it comes here equal next month's production requirement is 4,500. You don't have to maintain the full requirement, only half. So I divided by 2, 2,250. What about November? November closing stock equals to December requirements half. Half of the December requirements divided by 2, 3,000. What about this? What about December? December requirement is next month, that is January, half of January requirement, 3,750. And then again the same thing. Now your requirement is 3,600. Your closing stock is 2,250. You have the total 5,850. Do you have to purchase all these 5,850? Or do you have an already opening stock? You have an opening stock. So you can deduct that opening stock and you can just purchase the balance, right? You can deduct your opening stock. What is your opening stock as at October? What should be your opening stock? October opening stock. October opening stock means what? September closing stock. September closing stock. What should be September closing stock? October production requirements, half of the October's production requirement. So October production requirement was 3,600. Half means 3,600 divided by 2, 1,800. So you can deduct 1,800 from there, right? What about, now that is the calculation you need to make. What about November opening stock? November opening stock means what? October closing stock. What is October closing stock? 2,250. You just get the number directly linked. Always you link like this. What about December opening stock? December opening stock means November opening stock. No, November closing stock. December opening stock means November closing stock. So you take November closing stock 3,000. Right? And then I'm not going to fill January here. I'm not going to fill January here. Now I'll tell you the reason why I took one additional month to get these amounts, to get these 3,750 here from this 7,500. You have to calculate all these things for the next month, one additional month. So that's why to accommodate getting this 3,750, I added one additional month like this and I did the same calculations and then only I could get easily this 3,750. So from this point onwards, I won't need that. I don't need that additional month. So I hope that is clear. Why I took 7,500 up to this one, the additional month. Why I used additional month. Right. Now you can have, now 3,600 is your material requirement. You know the closing stock. You deducted the opening stock. Then I get the numbers like this. Do you all have the same numbers if we have done individually? Are you clear up to this point? Any doubts? Any clarifications up to this point? Are you clear? Even though there are 24, including me. So without me, it should be 23, no? So how many of you are actually doing this question with me? Okay, thank you very much. Right, okay, right, okay. So now we have the quantities, production requirements, that means kilograms. And now you can multiply by the values, unit prices. What is the price of 1 kilo? 100 rupees. So I'm multiplying by unit price per kilogram, 100, 100, 100, then multiplied by 100 multiplied by 4,050, like this. These are the direct material cost of these direct materials. Right. Next budget. Now we are done with direct materials usage and then direct material purchases. And now we are moving to direct labor, direct manufacturing labor cost. Again, direct labor requirement is also based on production, isn't it? So I'm taking the production numbers. 1,002, I'm linking these numbers, production. So how many hours we need to produce one unit? 2 hours. So hours per unit, 2, 2, 2. And then what is the total hours then? 1,200 multiplied by 2, like this. These are the hours. What is the hourly rate? Hourly rate is 60 rupees per hour. Now, in your organization, there can be changes. Now, here we discussed only one raw material type. There can be so many other raw material types in the real world situation. So you will have to prepare raw material number 1, raw material number 2. Likewise, you will have to prepare separate budgets. And then you can link everything together, right? So different types, different budgets. Direct labor also, trained labor, untrained labor, type 1, type 2, grade 1, 2, 3. Likewise, there can be so many labor types. But individually, you apply these numbers. Sometimes the hourly rates are getting changed. Hourly requirements are getting changed. So you get these things individually and then collate. And then here 60 rupees multiplied by 2,400 total requirement, and then likewise you get the cost, direct labor cost. So these are easy budgets, right? Easy, just multiplying with the numbers. We are done with manufacturing labor budget as well, and then manufacturing overhead cost budget. So how do we allocate manufacturing overhead cost? Based on absorbed into products on the basis of direct labor hours. Okay, now do we know the direct labor hours we need? Yes, we know. What are the hours? Our requirements? Total hour requirements are 2,400, 3,000 and 4,000. I just took those numbers from the manufacturing labor cost budget. And then what is the overhead absorption rate? 40 rupees per direct labor hour. So 40 and 40. Just like that, you can get the values. These are the values, right? Okay, so that is manufacturing overhead cost budget. Next one, non-manufacturing overhead cost budget. Now we have to prepare non-manufacturing, that means expenses budget, expenses. Now look at the non-manufacturing overhead cost we have. We have sales commission paid for sales on cash basis, only for cash units, 5 rupees per unit. So what do we need? We can directly multiply. We can multiply 5 rupees by cash sales quantity. Do we have the cash sales quantity separately? Yes, sales quantity cash basis 400 in October. Since I have the formulas, I'm just copy pasting and then the numbers getting changed. 5 rupees multiplied by 600 in December. Likewise, you have the sales commissions. What about administration cost? That is fixed every month. So it's fixed 30,000, same 30,000, 30,000. Right, I have a problem now. When it comes to non-manufacturing overhead cost, do we take depreciation as well into this budget? Even though you have the number, you have to decide. You have the name given here, you have to decide. Do we take depreciation as an expense into the non-manufacturing overhead cost budget? What do you think? Do we take that? Depreciation is a non-cash outflow. It's not cash basis, but still do we take depreciation expense coming under non-manufacturing overhead cost budget? Non-manufacturing means expenses. Exactly. Even though it is on cash basis, it is not on cash basis. It is an expense, non-cash expense. So into the budget, when you calculate the expense, you need to take that depreciation as well. So what is the depreciation amount? 8,000 direct monthly fixed. 8,000, 8,000, 8,000. So these are the only expenses in this example, but just imagine your organization. There can be so many expenses, and then you have to take them individually. You have to think about those expenses individually based on your projects, based on your expansions, based on your new requirements. Expenses can be changed, right? So these are the expenses, likewise non-manufacturing overhead cost budget. So with that, we have finished sales budget, a simple example for a sales budget, a simple example for a production budget with the closing and opening stock conditions, and then direct material usage, direct material purchases, direct manufacturing labor cost, manufacturing overhead cost, non-manufacturing overhead cost. We have done up to this point. Now we are moving to cash budget. Cash budget. Now, what are the two things coming into a cash budget? Cash inflows and cash outflows. Inflows and outflows. What are the cash inflows available? In this example, basically, we have cash sales. So we have cash sales. That means it's a direct cash inflow into the organization. So I link these cash sales from the sales budget. So we have the number separately. Sales, revenue, cash basis 600, 720 and 900. 600, 720 and 900. Directly taking from cash sales. And then we have the other source is not credit sales. I can't say credit sales, but cash collection from the debtors. We are receiving money from debtors. Now, can you remember the condition? How the debtors are going to pay us money? 50% in the current month, 30% in the next month, 20% balance in the next month. After 2 months, that means. So if that is the case, can you just write from the sales budget 920 like 912 like this? Can you just write 912 sales budget from the sales budget? Can you write in October? Amount received received from debtors? You can't. You can't write that because they are going to pay amounts over 3 months. So that is why we are not getting 912 total amount in October itself. So in that case, we need to have a small working for that. So that's why I have linked cash collection from debtors. You need to have a working. So I'm moving on to the working. This is the working. This part. Working number one, debtor cash collection. Now what do is, just forget about this October and September. Just look at this, I'm deleting this as well. Just look at October credit sales. How much is October credit sales? I'm just getting the number here. October credit sales. October sales revenue credit basis 912,000. Okay, I got this value. When it comes to October credit sales, 50% of this would be received in which month? 50% of October sales, credit sales, would be received in which month? What is your answer? 50% of this would be received in which month? 50% of October will be received in October itself. Am I correct? Exactly. 50% of October will be received in October itself. Then, if I just take 912 multiplied by 0.5, 50%, 456 will be received in October itself. What about 30%? 30% will be received in the next month. That means November. So you are taking 912 multiplied by 0.3, 30% in November. What about December? Balance 20%. So 912 multiplied by 0.2, the balance 20% will be received in December. So this is correct, right? This is total 912,000. 912,000. Are you clear with that? Can you fill November, December? November, December as well. What do you do is you take first November credit sales. That is easy for you. That's not mandatory, but easy for you. November credit sales is 1.094 million. And then, do you have any amount received in October for November credit sales? Do you receive any money in October for November credit sales? Will you be receiving any money in October for November credit sales? Or is it starting from November? It's starting with November, exactly. You're not receiving any money in October. That's why it's 0. Because it can't be the case now. How can we receive money in October for November sales? We are going to start receiving money from November. 50% in November itself. That means this amount multiplied by 0.5 November. And then the balance 30%. 30% in this from this amount 0.3. 30% in December. What about balance 20%? That will be received in January. So that means this amount multiplied by 0.2 January. Right? So that is again getting total correct. No difference. This is how you are going to receive money for November sales. I'm doing the same for December quickly. December credit sales is 1.368 million. You are not receiving any money in October or November. October or November. You are starting from December. December, you are receiving 50% of this. Right? 50%. January, you are receiving the next month 30%. 0.3. February, you are receiving the balance 20%. Balance 20%. This is how you write. Right? So even though these 2 months are not relevant to you, just for your working purpose, I have added. Right. Now, are we done? Are we finished here? What about October? In October, do you receive any money other than this October credit sales? Other than this 50% of October credit sales, will you be receiving any other amount? What is your idea? In October, do you have any other, exactly, do you have any other amounts? Yes, what about September? What about September? September, 50% of September credit sales, right, received in September itself. That is gone. 50% of September will be received in September. 30% of September will be received in the next month, that means October. So don't you need September credit sales? You need September credit sales as well. Now, in your activity, again, there's a small error. There's a small error in your activity. Just change these numbers, October, November, December, under point 9 as these things. July, August, September. These 3 months as July, August, September. July, August, September. I just realized it. July, August, September. Here also, point X also, July, August, September. Change these names. Months. Now read. Actual credit sales details for month of July, August, September 2025 are as follows. Now, what is here? September. This is September, right? Instead of December, you write September here. This is August. And this is July. Right. Now, September, what is your actual credit sales? 120,000. September actual credit sales is 120,000. So I'm bringing that amount here. 120,000. September, 50% of this would received in September itself. 30% will be received in October. So I'm just taking 0.3 multiplied by 120 in October. Balance 20% will be received in November. Balance 20% will be received in November. This is how it goes. What about August? August, 50% will be received in August itself. 30% of August will be received in September. And then the balance 20% of August will be received in not August, not September, but in October. So here, what is applicable? 20% of August credit sales. How much is August credit sales? 110,000 with the changes, 110,000. So I'm writing 110,000 here. And then I'm multiplying 110 multiplied by 0.2, 20%. These are the amounts. Do we have to consider July credit sales? What is your idea? Do we have to consider July credit sales? July 50% received in July, 30% received in August, 20% received in September. Any amount coming to October or not? No, that's gone. Ideally, it has ended, right? Ideally, in ideal case. Here we have not considered any provisions, bad debts or anything. Simple fundamentals, right? Okay, so with that, I'm taking the totals, total data collection for October, November, December, like this. And then having done the working, I'm linking October, 504,000, November, this amount, I'm just copy pasting the amounts like this. These are the data collections. Are you clear with the data collections? Are you guys clear with the data collection working and what you did? So maybe you can apply these fundamentals in your real world organization situation, right? Okay. Right. So those are the cash inflows in this example. I'm moving to cash outflows. Cash outflows, number one is creditor payment. Creditor payments. Now, if you can remember, when it comes to creditor payments, here, payments for raw materials, that is for the creditors, no payments for raw materials are to be made on average 2 months after the delivery. If you receive the stock in October, you will not pay in October, you will not pay in November, but you will pay in December after 2 months. So again, can you just link the number from the purchaser's budget? No, you can't. You need to have a working because there are month differences. So that's why you have another working here, payments to creditors. Payments to creditors, same format. So I have the relevant months, October, November, December, and 2 additional months. We need them. And then I'm starting with October. How much is October purchases? How much is October purchases? What is the budget you need to refer to? Direct material purchases budget. October purchases is 405,000, right? Shall I write November purchases as well? Since it is easy. November Direct material purchases 525, and then you have 675, that is for November. So these are the purchases. Now tell me, when it comes to October, even though the October amount is 405, are you going to pay that in October? No. Are you going to pay that in November? No. Are you going to pay that in December? Yes. Half or 30% or 20%? No, it's not the case. It's a full amount, it seems. As per the question, you are paying it fully. It's starting in December, correct. What about November? Are you going to pay in October? November? Are you going to pay in November? No. Are you going to pay in December? Again, no. But in January. So in January, you will be paying this full 525. What about December? Are you going to pay in December? No. Are you going to pay in January? No. But in February, 675. What about September purchases? What about September purchases? Look at the last point, number X. Actual direct material purchase details for the month of July, August and September 2025 are as follows. Again, as I told you previously, change these months as July, August, September. July, August, September. So this is September. This is September. 400,000. September 400,000. So I'm writing 400,000. Are we going to pay that in September? No. Are we going to pay that in October? No. Are we going to pay that in November? Yes, we are going to pay that in November. What about August? This is August, no? November becomes August. This one. 380,000. 380,000. Are you going to pay that in October? Sorry, August? No. September? No. In October. So that is the amount coming to October. Likewise, you have a pattern, right? With the condition, you have a pattern. This is how you are going to pay your creditors. So when it comes to the cash outflow in October, that is equal to 308,000 October. November, it's only 400,000. December, it's only 405,000. We don't care about January and February because we are not prepared in the budgets. Right. Direct labor cost. Quickly going. Direct labor cost, when it comes to direct labor cost, what is the amount? You are going to pay that in the month itself. No, we can't delay the direct labor cost. So you go to direct labor cost budget. This is the cost, 144, 180 and 240 directly coming from this budget. What about manufacturing overhead? Now this is important. What is manufacturing overhead cost? 96, 120 and 160. This is your budget. Can we take these numbers directly into the cash outflow? 96, 120 and 160? Can't, since it has a condition. See, manufacturing overhead includes 30,000 of fixed machine depreciation each month. Okay, that means if you take manufacturing overhead 96,000 in October, 30,000 machinery depreciation cost is also included in 96,000. Now, can we take 96,000 here, or do we have to remove that depreciation cost? What do you think? Can we directly take 96,000 here like this, or do we have to remove that depreciation 30,000 as depreciation is not a cash outflow? Even though we consider depreciation into the expenses budget, you can't consider depreciation in the cash budget because it's not a cash outflow. So when you have 96,000, you need to take a small adjustment, 96,000, that is correct, but remove minus 30,000. Only 66,000 can be considered in the cash outflow. Likewise, I'm removing 30,000 from 120, that becomes 90. I'm removing 30,000 from 160, that becomes 130. Are you clear? Are you clear up to this point? Hope that is clear, right? You can't take depreciation as a cash outflow. And then what are the other cash payments? We considered sales, we considered production. We don't have to consider production, but we consider direct material purchases, we consider direct labor, we considered manufacturing overhead. What is that? What is left? Non-manufacturing overhead. Now, when it comes to non-manufacturing overhead, again we have depreciation. Do we consider depreciation in the cash budget? No. So we are considering only sales commission and the administration expenses. So that's why I have written sales commission and administration expenses. So I'm just taking the numbers from the budget and then copy pasting like this. 240, 30, 3 and 30. So these are the cash outflows. So in this question, we have only very limited line items. No? So I'm taking cash inflows, total of cash inflows here. Just a matter of adding cash sales and the data collection like this. I'm writing these numbers, total numbers. And then I'm taking cash outflows, the totals of cash outflows like this. And then I can calculate the net cash flow, net cash flow. Always net cash flow equals from the total cash inflow, you deduct total cash outflow. What is the net inflow? Right? If the outflows are greater than the inflows, this will become negative. Right? This will become negative. Again, for November, inflow is 1.5 million, outflow is 702. So you have a net inflow of 862. December, 2 million inflow, 808,000 outflow. You have a net cash inflow of 1.2 million. Right? So this is the net cash flow during those months. And now, if you take October, I didn't mention that in the question, right? Yes. Now, if you take this one, October, when it comes to opening balance, you have to put an amount. That means you are talking about October budget, no, October, November, December budget. But you have the actuals. You have the actuals up to September maybe. So at the end of September, you have a cash balance in the organization. Cash, bank balance, you have a balance. Now, when you prepare the cash budget, October opening balance means September closing balance. Let's say you can put any number here. I'm just taking 300,000. I'm just taking 300,000 here. So my opening balance of October is 300,000. Like this, 300,000. So what is the October end closing balance then? October beginning, you had 300,000 hand balance, cash in hand, or the bank balance, plus you have a net cash inflow of 492,000 during October. So in that case, closing balance would be 792,000 at the end of October. At the end of October. This 792 becomes the opening balance of November. Always closing balance becomes the opening balance of the next month. So October closing 792 becomes November opening, which is 792. Then what about the November cash balance, closing balance? You have 792 plus you have a net amount 862,000 net inflow, you add 1.65. So you have a closing balance of 1.6 million. That becomes the opening balance of December. And then finally again, like this, you can take the total. Right? Hope you are clear with this one. Are you okay with this calculation? Are you clear with that? Right. Now let's say when you have a budget, when you prepare the budget like this, November, you have 1.6 million as the budgeted closing cash balance. But when you discuss with the managers, when you discuss with the senior management, you are not going to have any projects or special capital requirements or anything. You need only 1 million. You need only 1 million for your daily business operations, right? You need only 1 million. In that case, what is your excess amount cash balance? This is your requirement. What is your excess balance? 654,000 extra, because you need only 1 million, whereas you have a balance of 654,000. So in that case, this extra balance can be maybe invested, maybe put it into a fixed deposit, right? Invest in money market, buy in treasury bills, likewise. So you can find out from the cash budget whether you will be having extra cash amounts, extra cash balances in the coming months. Based on that, you can plan accordingly, right? Now, this is why I didn't have an amount in the question. What if your cash opening balance would be 1,000 rupees? And for calculation purposes, I'm just changing these numbers only for calculation purposes. Okay, now what about this? If this is the case, net cash flow is 72,000, but that is minus. You have an inflow of 550,000 expected, whereas your expected outflow is 622. That is 72,000 minus. You don't have, there's a cash shortage. And you have an opening balance of only 1,000 rupees. What should be the decision? What should be the immediate decision? If something like this happens, you have a cash shortage in the next month. Working capital borrowings, exactly. You can talk with the bank, you can have some funding sources. You will have to find money for your business operations. So you realize this problem with the budget. Short-term finance sourcing like overdraft, trade credit arrangements, exactly. Maybe you can negotiate with the suppliers. You can negotiate with the suppliers and delaying this payment, right? You can negotiate with your debtors and getting the payments, right? Different strategies, discussing with the bank, discussing getting an overdraft facility, and different things can be there. So using the cash budget, you can make so many decisions based on the cash balances available. So this is how you basically, these are basic budgets, right? I'm repeating, these are basic budgets with a basic question, but this is how you can come up with the budgets in an organization, right? Give me a second. All right. Do you have any concerns? Do you have any issues? You can ask. Now, one more thing. When it comes to now this is a production company, this is a manufacturing entity, right? That's why you have all these sales, production, direct material purchases, everything. What if this is a trading company? Trading means you are just buying and selling. You just buy, you sell. You're not doing any production. What are the budgets we need? Do you need sales budget in a trading company? Will you be Do you need sales budget in the trading company? Do you have to prepare that? What do you think? In a trading company, do you need the sales budget? In the manufacturing company, you prepared, right? So my question is, do you need a sales budget in the trading company? Yes, of course, you need that sales budget. But do you need the production budget? Do you need the production budget in a trading company? Are you going to produce anything? No, you don't. Do you need the direct material usage budget? No. Direct material purchases budget? No. Direct manufacturing labor cost, manufacturing overhead. Do you need non-manufacturing overhead cost budget in a trading company? What do you think? Non-manufacturing overhead cost. Yes, not in the name of non-manufacturing overhead, but expenses budget. You need that. Do you need a cash budget? Of course. Then instead of production and these related direct material, labor, manufacturing overhead, what do you need? Instead of all these budgets, what do you need? Instead of these budgets, what is the budget you need? I would say the purchaser's budget. You need to purchase, no? If you are now, your purchasing would be that will base on your sales. You prepare the sales budget. If there are no any other matters, you prepare the sales budget and then you decide, okay, what is the quantity you need to purchase? It can be the other way around as well. Let's say if you have a limitation with the purchases, you have a limitation with the purchases. So you prepare the purchaser's budget. This is the amount we can purchase, and based on that, this is the sales. It can be both, right? So instead of production, you prepare purchaser's budget. Right. This is how it goes. And then, exactly. And then when it comes to the slides, we have covered all these things. This is one template for you to use for cash budget, right? If you have any other expenses, you can put them. And then alternative approaches for budgeting, actually we discussed them. Incremental budgeting we discussed, zero-based budgeting we discussed. Activity-based budgeting means you budget for activities. Instead of now monthly you have, now here we have cash budget and all, these sales budget, production budget, function wise. Now, when it comes to activity based budgeting, you target activities. For this activity, what is the amount we have to allocate? For this activity, what would be the cost? For this activity, what would be the cash inflows, outflows? Likewise, you focus on activities, activity based budgeting, right? Now, here in this example, no activity has been focused. But in activity-based budgeting, you focus on activities. You prepare the budget for activities. And then flexible budgeting. Flexible budgeting is also important. Now, if there are volume or capacity, activity level changes, now it's like if 100% is utilized, this would be the cost. If it is 80%, look at this one, I'm not explaining, I will give you the answer. At the 60% of capacity level, these would be the cost. But if you are increasing the capacity level to 80%, when you are making decisions, what if we increase the capacity for 80%? What are the costs we need? So direct material, labor cost will change accordingly. Fixed cost, what will happen to fixed cost? See, it would be the same. What would be the cost if we work with the full capacity, 100%? What are the costs? Likewise. So I will share the answer I will show you the answer first. Activity to working. This is the working template I have shared with you. And this is the answer. So you will be able to understand. I have input data also here with the functions. Just check how we can prepare the flexible budgets at the 60% capacity, at the 80% capacity, maybe 100% capacity. So when there are capacity changes like this, you can always change the numbers accordingly, right? So I don't have time to explain the flexible budgets now. Right. So yes, our guest lecturer has also joined the session. Mr. Madhuka, can you hear me?
Yeah.
Yeah.
Yes, can hear you. Can you hear me, Natasha?
Yes. Give me a second, Mr. Madhuka. I'm just finishing off the session.
Right.
Okay. So that's how we can explain these budgets, and thank you. And I will share the answer for flexible budgets as well. Right. Give me a second before moving to a guest lecture. Mr. Madhuka, do you have anything to share?
Yes, I do.
You have the sharing option, right?
Right, I have.
Okay. Give me a second. Okay, so participants, for today's guest lecture, in order to discuss the practical applications of budgeting, now we have completed the theoretical aspects and some new budgeting techniques. So we have invited a professional from the industry expert. Uh, he is Mr. Madhuka Karunadharma, and he is the country finance head of Reckitt. And then he has experience in several other organizations, including Daras and then Unilever, Dialogue Axiata, PSA. So with his experience, he will explain how these budgeting techniques can be used in the practical setting. So uh, he's a graduate of University of Sri Jayawardenepura, holding bachelor's degree of business administration and also having a master's degree from University of Colombo. So with his experience, he will definitely share his valuable experience with us. So over to you, Mr. Madhuka. Thank you very much for joining amidst your busy schedule. So over to you.
Thank you, Natasha. Thank you very much for the kind introduction. So good morning to all of you. Okay, give you a little bit of background about me. Currently I'm working as a CFO or country finance head for Reckitt-Benckiser. Whoever in this classroom right now, whoever who have used Dettol, Harpic, Lysol, any of these products, we are the company. Reckitt-Benckiser is a company who manufacture or import those to Sri Lanka and distribute island-wide. So Reckitt is a multinational company, a multinational FMCG company, which has its roots from the UK, just like Unilever. And so before coming to Reckitt, I have been in different industries. So I have been in FMCG, I have been in services like telecom, and I have been in e-commerce, and I have worked for a heavy manufacturing, 100% manufacturing oriented company as well. So all of these different experiences in different industries gave me a different outlook for each and every industry, how the budgeting, how the real world application of accounting and finance is taking place in the real world. So just like you, I have also been a student in Jayawardenepura, and I've been learning budgeting, forecasting, activity-based costing, flexible budget. What you have just understood from your lecturer. So, but when we go to the industry, you see the way the budgets, the budgeting and forecasting is happening is very different, right? So I have very few slides that I have prepared, but it is mainly as a pointer. But I would like to keep this as a very interactive session that you can ask questions from me. So I will start the presentation now. So I put this heading as application of budgeting in the real world, right? So what I want to tell you is right now, so in your lecture today, or in your course slides, course material, you learned something called activity-based budgeting, right? Activity-based costing, or flexible budgeting, absorption costing, stand costing. So there are so many techniques that we learn during our courses, during our period of study, as when we learn management accounting. So in the examples that we work out in the classroom, so we see this is the production volume, this is the direct material cost per hour, direct material cost per unit, direct labor cost per hour. That is how we work out in the classroom, even for exams, right? But but the thing is, don't expect the same thing, don't expect the same scenario when you go to the industry, when you get your hands on to real world budgeting. So I have been fortunate enough, as I told you earlier, I have been fortunate enough to work for different companies and different industries as well. So what I understood is, what I experienced is, budgeting is unique from every organization to every organization, from every industry to every industry. right? Maybe in the same industry, the one company does their budgeting could be totally different to another company in the same industry, right? Can you have any guess why it could happen? What is the reason? Can you all hear me? Hello?
Yes, we can hear you.
Right. So can anyone tell me why the budgeting, like we learn like fixed materials, like okay, flexible budgeting or activity based costing, but I am saying budgeting can differ from company to company, right? So you won't see the same budgeting process because every company has its own dynamics, right? Every company has its own culture, right? Every company has its own accounting and finance culture, right? Every company's director board or the shareholders or the people who run the business looks at finances, how to manage their P&L will vary, because the way I want to shape up my P&L can be different to another company, how they want to shape up their P&L, right? And how do we optimize the cost can change from another company to another company, right? So therefore the, like, you might, like, in during your course studies you have learned about like shareholder value creation, right? So shareholder value creation is basically like how you create more value to the shareholder, how you increase the share value of the company, how you basically increase the value of the company. To increase the value of the company, you have to create more profitability for the company, and to create more profitability, then you have to understand, like, the way the shareholders will look at the P&L could differ. So that is the main reason why budgeting is like different from one company to another company, right? Uh, so this is my experience. As I told you, I have been in manufacturing and been in services and FMCG, right? So manufacturing company, like I work for a, multinational tire manufacturing company, right? So it is a Swedish-based multinational company, which is a heavy, like a solid tire, industrial tire manufacturing company. It is like the company's model is Sri Lanka manufactures tires, and 100% or maybe 96% of the production is exported to countries to USA and to the European Union, and some countries in Australia and Russia, right? So since it's been like hardcore manufacturing company, it is 100% volume driven business, right? So company gets a company every, like, beginning of the year, company during the budgeting period, company expects a total tonnage of tires to be produced in the next financial year, right? That again dictated to the company from the other selling companies all over the world, right? So based on that volume only, the company started doing their budgeting process. And if you take the manufacturing company, so this is sorry, very process oriented manufacturing business, manufacturing processes. So many processes. So there are main processes and there are sub processes, right? So manufacturing a tire, particularly very high tech tire, because sometimes these tires could have a weight of like more than 500 kilograms, right? 500-700 kilograms weight of tires, and some tires has a height of more than 6 feet, right? So these are like very very complicated processes. And when we do the budgeting for that manufacturing company, it has a mix of activity-based costing as well as absorption costing. So the tire production, where areas has a process in the machine. If the up to the final level, if the rubber component goes from one process to another process, then activity based costing is the best option, because you have to understand the activity, the cost of performing that activity, which contributes like 75% of the cost of the time. And all the other overheads that we do based on the absorption costing, because it is a also like variable costing, variable expenses, because they are very much driven by the volume, right? So that is how in the manufacturing company, it's a hardcore manufacturing company, how we did the costing, how I did the costing part, right? Maybe if we go and look at another tire manufacturing company in the maybe doing the similar tire, maybe manufacturing the same tire, but they may have different way of doing costing. But this is how this company did their budgeting. And in a service-oriented organization, because I have been like in Dialog Asiata some time back, and then e-commerce. So these are very much data-driven approach, because these are high growth companies, right? Like if you look at to like compare to very well established company, in a very well established company, you look at a growth of like you're expecting growth of less than 10% in the next financial year. But companies in tech space, in telecommunication and e-commerce, they always they always envision a growth of more than 30-40%, maybe more than 50%. Right. So in that case, it is very much data driven, and because tech companies are data driven, right? So because they have so many parameters, they have so many customers, and the customers usage, average revenue per unit, average revenue per data usage. There are so many KPIs in telecommunication business. So they have based on the data and the data availability on the current context, and based on their forecast, based on their targeted growth for the next financial year, they will do their budgeting. And e-commerce. So I have been, I work for Daraz Sri Lanka. I hope most of you have heard about Daraz, and at least one of you have purchased something from Daraz. So when Daraz has a totally different business model. Like it is like that business model, it changes everything. It is like the industry is very dynamic. And in Daraz, you have marketplace, you have retail business, like all or everything is online. But there are so many areas to look at. You have to look at the seller's commission, and then you have to these are the main revenue, like commission that you are getting from the sellers, and commission that the revenue that you are getting from delivering parcels, or delivering the goods that you have bought from the purchase from the platform. And there are like payment services. So there are so many revenue lines, as well as there are so many expenses line. But again, this is very much driven by the number of orders and the average order value that the company is planning for the next financial year. Let's say Daraz could decide in the next financial year, we want growth, right? We want growth in terms of, not in terms of volume, but in terms of the revenue, in terms of the profitability, right? So then Daraz's management can decide, okay, we are targeting a high average order value orders. Like we will give more push, we will give more prominence to products higher value and higher profitability, not the lower value, lower profitability products. So in that case, you will see, like you can see, we are expecting a less number of orders. When you expect less number of orders, obviously the logistics part, the logistic component of the company, that also can be curtailed, that also can be scaled down. Like if you are planning to deliver 35,000 orders a month, right? At the current context, at lower average order value, 30,000, 35,000 orders. But if you go for a higher order value products, if you are giving more prominence, if that is a strategy for the next year, you might see number of orders to be delivered in the next financial year can come down to maybe 25,000 orders a month. So in that case, you have to scale down your logistics operation. You can reduce the number of riders you have. You can reduce the number of lorries or number of hubs that you are maintaining, right? So based on the business strategy for the next financial year, again, your budgeting process, your budgeting principles can change. For an FMCG company, what I'm working right now, the company that I'm working now. So for FMCG company, you know, so in FMCG company, there is it's a brand driven business, right? It's very much sales oriented and brand driven business, right? So FMCG companies, if you know, like from your grandparents' time, people go for the people are going for a brand. So that is why even for a normal soap, right? Normal washing soap, people are going and asking for a Sunlight. Maybe they ended up buying a different brand, different name, but they go and ask from the merchant, give me a Sunlight. It's the same thing like you're looking for a Bata slippers when the slipper is actually a brand is from it's a DSI product, but we are going and asking for a Bata, right? So and like nowadays people are asking for diapers. People are saying I want to buy Pampers. It is not Pampers. Diaper is the product, but Pamper is a brand. But since Pampers have so ingrained in the culture with the people, so everyone is asking Pampers are finished, so I want to buy more Pampers, but actually they want to buy diapers, right? So that is what is the impact created by FMCG, global FMCG companies. They invest so much in building a brand, right? So when you invest in building a brand, and the brand culture and the value of the brand is so ingrained with the people, then it is very easy to sell. So if you look at Dettol, Dettol is the core brand, but Dettol has Dettol plasters, Dettol has antiseptic liquid, Dettol has hand wash, Dettol has soap. So these are all SKUs, like sub SKUs of this brand. So when the Dettol brand is so significant, when the Dettol brand is so powerful, whatever the product that we put into the market under the Dettol brand will get sold, right? That is what FMCG companies are doing. Because FMCG says, like the name also, the acronym itself, if you expand the acronym itself, it says fast moving consumer goods, right? So FMCG companies are making money as much as these products are being used in the market, right? So FMCG companies like Unilever, they have huge market shares. For some of the products, they are the de facto market leaders for decades. For Signal in the toothpaste market, they are the market leaders for decades, right? And they have over 70% market share for toothpaste for the longest time, right? But so then can they increase their sales? So can they increase? So there is a limit that they can increase their sales in the current baseline, right? So what they can do, they can to increase their sales, they have to expand the market. So at one time, Unilever was spending money doing activations all over the country to make the habit for people to brush their teeth twice a day, because they have found out that in our population there are a significant portion of people are brushing their teeth only once a day. So if you increase the frequency, automatically your market get expanded and your sales will get expanded, right? So then these are small products, but very, very high volume, right? So in that case, the product costing is again very crucial, and the margins that you are working with and these are highly competitive, because for toothpaste, there are hundreds of toothpaste in the market. For soap, there are hundreds of toothpaste you have in the market, right? So then the game that you can play in the market to stand out, it is building a building a very strong brand and and competing in terms of prices, right? These are the two deciding factors, right? So for an FMCG company, so bill of material is very crucial, because bill of material tells you the direct materials. In an FMCG product, it is definitely, it is 65 to 70% is the cost of the material. Balance is 30%, right? So then in the bill of material, it says, like, because in all of these products, even if you take a soap, piece of cake of soap, there are so many sub materials, many chemicals, many sub materials. So we have to know, okay, from every each and every material, how much of lead to how much of what is the amount, what is the volume that you are putting into the bill of material. So based on which, because it defines 75% of the product cost. Are there any questions? I'm just going on and on. Like, if you have any questions even now, like, you can disturb me. Can everyone understand, like, is there any relevance with what you have learned today? Everyone is very silent. Is this how the class is, Natasha? Like,
Only one was talking the whole day, and then others are chatting in the chat box. That's how it
okay,
goes.
right. Okay, so I will go to the next slide then. Hope like everyone understand, like everyone can relate what I'm explaining right now. Okay, so then I took a just to show you a process, the real world budgeting process. So I took an example of a budgeting process that I currently get involved in my current company. So the budgeting process, as I told you earlier, budgeting process can change from company to company. This is how my current company is doing their budget, right? So as I told you, like, it is a like multinational company. So we have actually three budgeting rounds a year, right? So we initially prepare a budget for the next financial year, right? So that happens. So that is even now, right now also it is happening, right? So we try to conclude that budget for the next financial year, for financial year 2026, by somewhere like end of August, right? That is for the next financial year. And at the same time, in the next financial year itself, we have another three budgets that we deliver, that we do in the same financial year, in addition to the main budget that we prepare. So we have original budget that we are preparing for the financial year, that we call as Plan 26. So if you take this year's Plan 25, that we have concluded the process, that we have concluded last year, somewhere in August, September time period. So that is the Plan 25. So in 2025, we have another three budgeting rounds. That is forecast 1, forecast 2, and forecast 3. So then someone can think, okay, like, we thought like there is only one budget for the organization for the financial year. Then why do you have three budgets? So that is because the business changes, right? So we do a budget, because these are global companies. You can't just create a budget like within a week, right? Because there are so many parameters, so many variables to look at, right? So and then we prepare the budget for Sri Lanka, and then it's get amalgamated with Bangladesh as a cluster, from Bangladesh to India as one component, then India, then Middle East, Pakistan, all the other countries again, and then all the other countries again with then African region, and Africa, then Europe, US, is all like it's the entire globally all the companies, all the markets have to like they prepare the budget, and that has to be amalgamated, and that is the final budget, that is the final P&L that they are driving, that we are chasing after the next financial year. So it is a like huge process. So that is why for the next financial year, budgeting process starts mid of the current financial year, right? And then that gets concluded somewhere in August and September. It gets concluded. So that is how it goes, right? So then so we have done a budget for next financial year even before, like in the mid of one, like after the first half of the current financial year. So there can be so many changes in the next financial year, right? So then the budget that we have submitted in the last financial year may be not valid in the second month or third month of the actual financial year, right? So then you have to do changes. Then we have to change our targets. Maybe we have forecasted a higher sales because of market dynamics, we are not going to achieve that target. We are not going to go behind that number. So it's no point that we are going behind a target that you can't achieve. So you scale it down, you reduce it. So based on which, because end of the day, it's a shareholder game. It's like creating value for shareholders. Then you have to reduce some expenses. So that is how it goes. Like it is like very vast area, but with the time limitation I have, this it's in a nutshell. That's what I explained you. So so we are given a top-down PNL. So top-down PNL is a number that the region or from like globally cascaded down to us. It tells us, okay, the Sri Lanka market, this is the revenue that you have to achieve, right? This is the gross margin that you have to achieve, and this is the corporate operating profit that you have to achieve. It is a top down. It is just numbers, and dividing it between volumes and or everything else is the responsibility of the management. So when we get a revenue, let's say next year, you need to have like 10% growth on your revenue compared to the current financial year. That we are going to end up at, right? So the revenue, this is the revenue that you have to achieve, and this is the gross margin that you have to achieve. So they give the number. So then it is our decision. We have to make sure, okay, we have to decide, okay, how we are going to achieve this revenue, right? So when we have the revenue, when they give us the revenue, based on the current volumes, based on the demand plan we have, based on the supply and demand variables, we dissect it to different brands, different SKUs. Okay, from this brand the contribution is this much, from this is the SKU that we are going to do high, and these are the brands. So for these brands we are going to reduce the price. For these brands these SKUs we are going to increase the price. And these are so when we see, because of some particular change in the market, the demand for these products are increasing. So therefore we put more volume we allocate more volume to these products. So likewise, we define the volume based on the revenue target given to us, right? And that is what I showed in so define the volume based on pricing decisions as well as the brand segments. Right now, for an example, for us, Mortein is a Mortein brand. I hope you have heard about Mortein brand. Mortein, like you have Mortein aerosol and Mortein foil. These are high value products, high value products, and and not significant volumes, and not very high gross margins as well. So in in such case, in such case, we have to define, okay, if they want us to increase the revenue, right? Then we might think, okay, then we will drive this brand in the next financial year, right? Or we and if the management wants us to go for a more higher gross margin, then we will shift our strategy for brands and products which gives us a higher gross margin. So it is basically a volume mix, sales mix which will give us the required the product mixes, sales mixes that will drive us to achieve these targets, right? So then we come to the main component of determining cost. Determine the cost of goods sold. How
Sorry,
to determine?
Madhuka,
Yeah.
Madhuka, can I, sorry for interrupting. Can I just ask a
Yeah.
question now? Your organization, obviously, it's you say it's demand, but it's not demand pull. Your corporate office is setting the targets, and the strategy would be based on the profit target.
Yeah.
And then for you to prepare your sales budget, are you depending? Are you investing on data analytics, or how are you going to establish your market? It's a very, because it's not, in a way it's good because it's not demand pool. You have a product and you're going to push it, right? But
Yes.
how are you establishing your sales budget?
So sales budget in the sense the sales target.
Yeah, well, say now the thing is, you said the corporate office is setting the overall parameter or the strategy, right?
Yeah.
Then you have to break that strategy down into your own strategy, and so to arrive at the numbers, are you obviously you'll have to depend on data analytics, right?
Of course. So it is like, so that's what it's so much of data. Again, the good question that you asked. So it could be, so right now the market, so FMCG markets, like FMCG market is like inundated with so many suppliers, like so many players in the market, and the price war is like very it is very competitive right now, right? So there are so many brands giving the same product, putting the same product into the market. Then how do we stand out, right? So that is why we have a demand plan. So basically for the next financial year, when we are deciding what are the brands that we want, that's what I told you. We have a view. So how are we going to manage the sales mix, right? For an example, what are the products? So there are high value products with low margin. There can be low value products, maybe with higher margin, right? Maybe the same product maybe have a lower demand. Some product maybe have a higher demand, right? So then, and in FMCG market, you have two customers. You have the general trade, right? So the general trade is the trade that we cover the country through groceries and wholesale stores. And then you have the modern trade, all the supermarkets, maybe Cargill Steel. So it's a different strategy. How are we going to, so whether we are pushing the product, whether we are pushing the product to the market. So when you push the product to the market, then there are risk of wholesalers or the stores or the modern trade can't push it back to the consumer. So that is why you might have seen we are running so many promotions for the consumer, right? So then we are incentivizing them to buy more of the product, right? At the same time, we want to incentivize our customer also, maybe the distributor, maybe the modern trade customer, to buy more from us, right? So for that, again, then there are so much of other schemes that we implement, that we invest on, for them to buy more from us.
Yeah, the Madhuka, now the thing is your marketing team.
Yeah.
So basically, you all fix on a particular volume and then work towards that. So you might be way
Yes.
off. Your budget might be way off. So what I'm saying is,
It's not it won't go way off. It won't go way off, right? So when we do the budget, when we plan the mix, when we plan the sales mix, it is based on the existing data, existing patterns. existing market dynamics. So all these are like being daily monitored, daily, weekly monitored. What are the brands are driving? What are the campaigns which are working? What are the campaigns which are not working? So those data is always there with us, right? So based on those data only, we plan the sales mix. So it doesn't go way off, because in the beauty of from the FMCG market, because these are maybe like some time back, these are like essential products, right? For these are home essentials, and we know how it can change. Like we know how the customers are, how customer behavior. We have, these companies have the data, right? So their sales mix won't go way off.
You have internal resources doing generating all this data to arrive at a fairly accurate number internally.
Yes.
Are you using outside resources, or you
We
must?
are not actually, we are not actually using outside resources. Sometimes we take we take this market research data maybe from this market research companies, but we use market research data mainly for advertising, to see whether the advertising of like TV commercials, the effectiveness of the TV commercials. You might do you have a sales background?
No, I'm having a management background. No, what I'm saying is, so who is taking the responsibility for the data? Because the whole budget is depending on the sales projections, right? So your marketing team takes
It's not only sales projection. It's about the demand, it's about the supply as well. The supply and demand, supply chain function is also has a major contribution towards the projection. Because maybe like, so let's say we are given a net revenue target, but even though they are net revenue target, then we do the sales mix. So we sales mix, then again we do the sales mix to arrive into a particular gross margin, because gross margin is also defined for us. But if the sales mix says X number of products and of one particular SKU, and the supply chain is saying due to these factors, we will not be able to produce this, then we'll have to go back to the board and change it, and then again we have to fine tune it to find the product, or to replace new products to again to achieve the same target.
Yeah. Okay. Thank you. Yeah.
Sorry. So then you determine the cost of goods sold. So cost of goods sold, as I told you, for products we have a bill of material. So bill of material is important for the products that we locally manufacture, and for all the raw materials and packing materials, there are rates given to us. Our procurement team is like negotiating with the current suppliers. Negotiations, like we want reduction in the cost, or like, okay, when even if they are trying to increase the cost, they will negotiate it down. So this long negotiations will take place, based on which we take the rates for raw materials, packing materials, and then manufacturing overheads. And so there are products that we import and sell, right? So these products are being imported from, again, Reckitt manufacturing companies all over the world. And for that, we decide like they are selling it to us at a transfer price, right? Like maybe from Reckitt UK, if you have ever used a product like Gaviscon, this famous gastritis liquid, gastritis suspension, it is manufactured in the UK. And then the Reckitt UK manufacturing company gives us a transfer price. At a transfer price, they are selling it to us. So then we decide, okay, we'll get an idea from them what would be your transfer price for the next financial year, and the transfer price. And then there are if like pharmaceutical products are like, it's no duty, but if there are products which has duty, based on the duty structure, then we know what will be the landed cost. So these are the parameters that we use, and based on which we can determine the cost of goods sold. and the cost of goods sold will give you the gross margin. Right, I'm going little fast. Gross margin, and then marketing expenses and overheads. Then we come into corporate operating profits. So the marketing expenses also, maybe sometimes they will tell us you can have your marketing, because marketing expenses is very much uh, uh, very much going hand in hand with the revenue that you want to make, right? You want to give more visibility, you want to create more awareness. If you have to, like, if we see a decline in a particular brand, let's say if we see a decline in a particular brand, uh, which is giving us a higher profit, right, which has a higher profit margin, but the traction is less right now. So then what would we do? Then we will spend more money on building the awareness for that product, right? So it is a marketing expense. So they will say, okay, you can increase, you can have marketing expense maybe 7 to 8% from your net revenue, maybe 10%. So that is again based on our strategy for the next financial year, right? So marketing expenses, again, it has TV commercial expenses, right? The cost of producing the advertisements, cost that we pay to different media channels, or um, and social media expenses, like how much we are paying for Google ads, how much we paying to Meta, like Facebook advertisements, like that is the cost. So those are the mainly expenses that is covered through the marketing expenses. These are again from marketing department, based on the activations or based on the advertisements that they want to roll out in the next financial year, based on which we will decide on the marketing expenses that will come to the corporate operating profit. So finally, what I would like to tell you is, as a finance professional, there are few factors that, like few variables that you need to be aware of. Like, I hope all of you are you have do have some exposure to the finance department, even if you are not like a pure core finance professional. Even like during a budgeting discussion, during a budget meeting, you can question your finance team, what are the factors that you have taken, right, when you do the budgeting, right? So the movement of the exchange rate is crucial, because in 2022 our exchange rate, it was pegged for 203 rupees, and suddenly it toppled. And it went up to 360 rupees. So the movement of the exchange rate is very crucial, right? So if you have delivered a forecast based on a lower exchange rate, thinking the exchange rate will uh, stay as it is, so maybe we'll have a very small, very minor volatility, and suddenly if the exchange rate goes haywire, then there will be the repercussions are very high, because then your P&L will be like totally out, right? So you have to be very aware of the exchange rate. So when you during the budgeting process, talk to all the banks that you are dealing with, all the treasury people of the banks, and check with them, because they have very good understanding on the movement of the exchange rate for the next financial year. So get their understanding, get their ideas before you create your P&L. Then the inflation, because inflation again plays a major role. Based on the inflation only, you can decide on, okay, what is your salary, what is the salary increase that you want to give for the people, right? If you like, maybe sometimes companies can decide on, okay, we want to give a better salary increment to the people, therefore we are cutting down from other expenses, right? Because inflation, maybe like inflation right now, like we are expecting a 3.5% inflation by the end of the year. So like maybe that is like, maybe, but still companies want to give like maybe like 8%, 10% salary increase, right? So then maybe to give that kind of salary increment, you have to cut down from other expenses, right? So, and inflation impacts all other material purchases as well, right? So this is again a like component finance people in the department, finance people in the function has to be very aware of when you prepare the budget. Then the global logistics front and the challenges it faces. You know, last year and this year, there are so many like global logistics front and geopolitical challenges which is come like together. If you remember last year, like you might have heard, there was a Red Sea, some fiasco in the Red Sea. So because of that turbulent situation in the Red Sea, like most of the FMCG companies, most of the companies got affected because all the imports got delayed. Right, all the imports got delayed, and the same time the freight charges have also increased because since we want to get our stuff quickly, right? So when you are, because your freight cost is again a key component of your cost of goods sold, right? Cost of goods sold. And when the logistics are challenged, right? Logistics front is challenged, then your imported products will not come on time. Then your sales target, your supply to your production targets, all can go to 6. Right, all can go to a different direction. It's not what you have expected. Then everything can get changed. So again, you as a business, you have to be very agile, to understand and address all these challenges, right? Yeah. So that is I could. So it comes to the conclusion of my slides. So I want it to be much more like interactive session. So if you want, if you have any more questions, please ask.
Right. So participants, if you have any questions, you can ask or put it into chat box. Yes.
Hello, Madhuka.
Yes, ma'am.
Hi, sorry, I couldn't join earlier. You know, I was late to join, but anyway, I hope that the session went well, and thank you very much for joining and explaining your practical experiences. So no question, just a comment. Yeah, thank you.
Okay. So strategies are and sources are uniqueness and what methods you use to communicate the top level. So there's one point: what methods you use to communicate the top level budget to lower and lowest levels, especially when the budget is amended. It should be communicated to lowest operational level immediately. What source documents you use in budgeting? So okay, so the communication, so Manjula has asked, what are the methods you use to communicate the top level budget to lower and lowest level? So there is no, when you're communicating a change, communicating a budget, there is no like the top level to the lower level or the lowest level, right? So that kind of culture is no more there, as I understand. You are, because because end of the day, you have the top management or the leadership team, and then you have the leadership -2, and then you have the other functions. So all these functions as just as a all the cog in the wheel, all are working together, right? So when as soon as the change comes, we do get together, everyone relevant is get together and do the necessary changes and find the challenges and communicate it. So right now, because communication channels are very open, communication, because if the right thing, if the communication doesn't happen on time, in this competitive world, competitive markets, you are going to lose out, right? So there is no so we have in our company, all of us are using emails. We have Microsoft Teams, WhatsApp groups. There are so many ways. So even during the budgeting period, during a troublesome period, even if that's the smallest change that we need to address, then it gets cascaded to the relevant one. It comes to the top level like leadership team. Maybe from finance side, it will come to me. Then I will immediately I will cascade it to my immediate team, maybe the commercial finance manager, or maybe someone else in supply finance. So then the change has to happen immediately, right? So you can't wait. So there is no like during a budgeting time, like during nowadays, I don't see there is like lower and lowest level, because things has to happen fast. Otherwise, you are losing out. Another question you have asked is what source documents you use in budget. It is mainly data, the actual data. So in our company, to get the actual data, there are so many sources. Maybe the like for sales, there is some different tool, and then you have the ERP. In the ERP, then you can take different types of data from the ERP based on the flexibility in the ERP. You can retrieve data from the ERP based on the queries you run. So actually it is our matter to give the correct query to the IT team. Then based on that, they will retrieve the information that we request. So Manjula, you were working for Lodestar, right? So you had worked for Lodestar. So you and I had been in the same industry. Any more questions?
So I hope there are no any other questions. So Mr. Madhuka, thank you very much for accepting our invitation and joining us this session, and you spend extra time as well with your sharing your personal experience. That was very fruitful even for us. So thank you very much for joining the session, and we really appreciate your effort.
Thank you, Natasha. Thank you, Luan, for inviting me. It's always a pleasure to share what we learn or what we have experienced. So Luan and I have a long history together from O-level time. So he had been a teacher to me as well several times during my school time as well. So it's a pleasure to share the stage with him again, to share my knowledge or the experiences. Yeah, thank you very much.
All right. Thank you, Madhuga. Thank you.
Thank you.
Thank you.